Hey, Brian, can you hear me?
Yeah, Tom, I can hear you.
Excellent. That was my radio check.
Good morning, everyone. Are you ready for another fun day?
Oh man, I'm excited.
Me too. Can't wait to do it.
Well, I want to tell you that I am jacked up on caffeine, and after this hearing's over, I'm probably just gonna keel over. So if I appear a bit jumpy, I'm gonna blame it on the caffeine.
You twitching a little bit, are you?
We're forewarned.
Exactly.
I stocked up on sleep. That helps me.
Yeah, me
When
too.
this is over, I'm gonna not be keeling over. I'll be probably mowing the yard or something.
It's supposed to be a little warm today.
Yes, there's that. But there's also knee-high grass. Well, I like to call
Knee-high,
it
that's
grass.
pretty good.
I like to call it grass. It's a mixture.
Mostly weeds, is that what you're saying?
Yeah.
Hey, there she is. We missed that voice yesterday.
You know, more pleasant than even Siri. Okay, I guess it's 9:30. And Commissioner Vicente Aguilar, are you with us?
Yes, good morning, Commissioner.
Good morning. Well, Mike, would you do the call to order and the roll call?
Yes, Commissioner Fishman.
Yeah, I'm here.
I still have to call you. Commissioner Hall,
Present.
Commissioner Vicente Aguilar,
Here.
Commissioner Byrd,
Present.
Commissioner Maestas.
I'm here.
Commissioners, we have a quorum. 5 commissioners are present.
Commissioner Byrd, I never thought I would hear you say present. But there you are. You're putting on airs. Okay, Pledge of Allegiance and State Pledge. You know, no one does it with as much gusto as Commissioner Byrd.
I pledge allegiance
Shoot.
to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. I salute the flag of the state of New Mexico and the Zia symbol of perfect friendship among united cultures.
We're on to consideration and approval of the agenda.
Move to approve.
I'll
Second.
second. Mike,
Commissioner Vicente Aguilar,
Aye.
Commissioner Hall,
Aye.
Commissioner Maestas,
Aye.
Commissioner Byrd,
Aye.
Commissioner Fishman.
aye.
Commissioner, the agenda is approved by a vote of 5-0.
Okay, next order of business is we've got a public hearing in the matter of New Mexico Gas Company's application. Well, the screen just went away, but for stretching out their February event spike in charges. And Ashley Shanauer, you have the floor from here, and I'm just hoping you can control this group of 5 jackals that you've got to guide through this hearing.
I'll do my best. Good morning. I see we have a court reporter here. So it's time to go on the record, Mr. Lee. Good morning, Mr. Lee. Yeah, good morning, everyone. This hearing is being held before the full commission, and all commissioners are present. Chairman Fishman, Vice Chairman Maestas, Commissioners Vicente Aguilar, Byrd, and Cynthia Hall. And we also have Mike Smith, the General Counsel, present in case he has any questions for any of the witnesses. We are going to follow the procedures that were set forth in the commission's order of well, not sure when it was, recently. And we're going to start with public comment. Then we'll have brief opening statements from council, approximately 3 minutes maximum. We'll have testimony from the witnesses, and then we'll have questions from any other party and commissioners and general counsel as each witness is presented. The commission will not make a decision during the course of this particular hearing, and I will not be making a recommended decision. We'll adjourn the hearing at the end of the testimony, and the commission will take up a decision in the course of its regular open meeting agenda later today, later this morning. Let's begin, but I'd like to start with appearances of counsel first for the gas company.
Mr. Presiding Officer, can you hear me?
Yes, I can.
Good morning. My name is Tom Domme, D-O-M-M-E, and I'm the General Counsel for New Mexico Gas Company. And appearing with me on behalf of the gas company today is Mr. Brian Haverly from the Kelleher Law Firm.
And you'll both be presenting witnesses?
Yes, we will.
Okay.
We have 3 witnesses this morning. Ryan Shell, the president of the company. I will handle Mr. Shell. Josh Tilbury, the director of gas supply. I will handle Mr. Tilbury. And then Dan Yardley, an expert in rate design and cost recovery. And Mr. Haverly will handle Mr. Yardley.
And staff?
Thank you, Mr. Hearing Examiner, Commissioners. My name is Bradford Borman. I am appearing on behalf of Utility Division staff. I'm joined by our witness, Gabriella Dashino. Also appearing here is Elizabeth Jeffries of our legal division, although I will be the person conducting the hearing.
Okay. And I understand those are the only 2 parties?
That is
Yes.
my understanding.
Yes, that's my understanding.
Okay, well, thank you. Let's go to public comment. Has anyone signed up for public comment? Isaac?
Mr. Shanauer, no one has signed up for public comment today.
Okay. Well, then we'll go ahead with the opening statements. I don't know, is that Mr. Dome? Are you doing that?
Yes, Mr. Presiding Officer, I'll be giving the opening.
Okay, go ahead.
Mr. Presiding Officer, Mr. Chairman, Commissioners, thank you very much. As I indicated, today with me is Brian Haverly from the Kelleher Law Firm. We are here to present our proposal for recovery of the extraordinary gas costs that New Mexico Gas Company incurred in February of this year. As with the other companies that have come before you over the last few weeks, we are proceeding under the extraordinary relief and variance measures and sections of Rule 640 of the New Mexico Administrative Code. During the event in February, the 13th through the 18th in particular, the company paid approximately $110.1 million for gas. Essentially, that week we paid what we paid all of last year for gas. Since the filing, we have recovered $2.6 million in the form of an EGS payment from one of our suppliers. EGS is Emergency Gas Services Payment. So we provided emergency gas service to them during the event. They paid us back. So 2.6 came back in. That leaves 107.5 million to be recovered. Our request today is to spread the recovery of this 107.5 million over 30 months, starting in July of this year and ending in December of 23. Our intent in making this proposal was to minimize the impact on our customers. We will present this proposal to you today through 3 witnesses. The first is Ryan Shell, the president of the company. Mr. Shell has provided direct and rebuttal testimony. And through Mr. Shell, we will introduce several exhibits so that the record is complete and before the commission, before you begin to cross-examine. This will include the application and the non-testimonial exhibits to that. The testimony will come in separately. Notice of the receipt of the funds that I mentioned, the $2.6 million, and responses to the commission's questions and to the bench request that we received from Chairman Fishman last week and filed the response yesterday. Mr. Shell's testimony covers two key aspects of this proceeding. First, he will testify about the background of what the company did before, during, and after the storm, so that the company was able to weather the storm without losing any customers and to begin to prepare for the next event, should one occur going forward. Secondly, Mr. Shell has and will address the request by the company for recovery of a 3.7% carrying charge during the 30-month recovery period using the company's average cost of debt. As Mr. Shell has testified, and I'm sure will answer questions to this effect, NMGC took out an initial loan of $100 million. This unexpected loan increased the company's outstanding debt by approximately 25%, from $380 million to $480 million. The loan will have to be reworked during the recovery period. The $100 million loan does not stand alone, but creates additional risk and uncertainty to the company, a risk and uncertainty issue that is reviewed by creditors and investors on an ongoing basis. And the best measure of the true cost of this extraordinary debt is not the interest rate on that loan standing alone, but the average cost of debt to the company during the recovery period. And Mr. Shell will testify about that and answer questions about that. The second witness is Mr. Josh Tilbury. He's the Director of Gas Supply for New Mexico Gas Company. He has provided testimony and has sponsored the exhibits that are attached to the application, including the chronology of all the actions that New Mexico Gas Company took before and during the week of the event. Mr. Tilbury details the company's gas supply strategy and activities. We rely upon base gas, storage gas, day-ahead gas, intraday gas. The company has a rather sophisticated gas supply strategy and program, and Mr. Tilbury will testify and has testified about that. All of that is intended to ensure uninterrupted supply to customers. Specifically as to the storage issue, and I know that the commission has raised that before and will probably raise that again today, Mr. Tilbury will explain that the storage program that the company has worked. It saved the customers money by providing gas at a low cost during this event. At the same time, a force majeure declared by the operator of the facility constrained to some extent the gas available and forced the company to obtain some gas at higher prices. And Mr. Tilbury can talk about all of that. Our last witness is Dan Yardley. Dan Yardley is an expert in rate design and cost recovery. He has provided testimony. He's provided initial exhibits with that initial testimony. He has revised those exhibits, and those are attached both to the notice and to his testimony to account for the receipt of that $2.6 million and to adjust the recovery to reflect the 107.5 and not the 110.1. So those are the revised exhibits, and he'll talk about all that. Alternatively, Mr. Yardley is prepared to discuss tables of alternative recovery designs consistent with the bench request that Chairman Fishman circulated. And so he's prepared to talk about that. And the table specifically attached to the bench request responses that the company provided. With that, Mr. Presiding Officer, Chairman, and Commissioners, we are prepared to call our first witness.
Okay, well, let's Mr. Borman next.
Thank you, Mr. Hearing Examiner, Commissioners. Bradford Borman, appearing on behalf of staff. As you know, this is the third of the three PGAC cases brought before the commission arising out of the February weather event. Many of the issues in all three cases are quite similar, so it may seem a bit familiar to you by now. In this case, it appears to me at least that the primary remaining issue involves, as Mr. Dome said, actually, NMGC seeking to recover carrying costs from his customers related to paying the extraordinary cost of the gas back in March. New Mexico Gas claims that it entered into an interim borrowing arrangement to pay those gas costs. And, you know, in my view, the difference between the costs of that interim borrowing arrangement and gas companies' requested carrying costs appears to be the key issue that needs to be determined in this proceeding. With that, I'm going to turn it back to Mr. Hearing Examiner and seek to proceed with this matter.
Okay, thank you. We'll start now with the witnesses. Mr. Dome, please call your first witness.
We would call Mr. Ryan Shell.
And Mr. Lee, could you swear him in?
You solemnly swear the testimony you're about to give in the matter now pending shall be the truth, the whole truth, and nothing but the truth, so help you God?
I do.
Thank you.
Okay, go ahead, Mr. Dome.
Thank you very much. Go ahead and state your name for the record, please.
I'm Ryan Shell.
And what is your position, Mr. Shell?
I'm the president at New Mexico Gas Company.
And how long have you been the president?
A little over 6 years.
Mr. Shell, you have before you NMGC exhibit number 1. Do you recognize that document?
Yes, I do. It's our application in this matter before the commission, along with related exhibits.
And the related exhibits are exhibits 1, 4, 5, 6, and 7 to the application, the chronology, the regional average pricing, exhibit 4, weighted average cost of gas, exhibit 5, intraday gas purchases, exhibit 6, and calculation of extraordinary gas costs, exhibit 7. Is that correct?
Yes, that's correct.
Was this exhibit prepared in part by you and under your guidance and direction as the president of New Mexico Gas Company?
Yes, it was.
Do you have any corrections to make to this exhibit at this point in time?
No, I do not.
Is this exhibit 1, NMGC exhibit 1, true and correct to the best of your knowledge?
Yes, it is.
Mr. Hearing Examiner, I would move for the admission of exhibit number 1, NMGC exhibit number 1.
Is there any objection? I hear no objections. Mr. Borman, you're muted.
Sorry, I'm muted. No objection.
NMGC exhibit 1 is admitted.
Thank you, Mr. Hearing Examiner. Mr. Shell, you have in front of you also NMGC exhibit number 2. Do you recognize that document?
Yes, it's our notice of receiving payment that you mentioned earlier.
Okay. And this was filed at your direction and under your instructions?
Yes, it was.
And very briefly, explain what was the purpose of this notice?
Yes, certainly. So one of our suppliers to our transportation customers did not deliver gas to our system for their customers, or their deliveries were less than their customers used. So under our tariff, we're allowed to charge that supplier a certain cost for that gas determined under our tariff. So that amount was 2.6 million. We asked them to pay that, and they paid it here recently. So we wanted to reflect that here in the filing.
Do you have any changes to exhibit number 2?
No, I don't.
Is number 2 true and correct to the best of your knowledge?
It is.
Mr. Hearing Examiner, I would move for the admission of exhibit number 2.
Any objection?
No objection.
Okay, NMGC exhibit 2 is admitted.
Mr. Shell, you have in front of you NMGC exhibit number 3. Do you recognize that document?
Yes, I do. It's my direct testimony in this matter.
Okay. And was this testimony prepared by you or under your direction?
Yes, it was.
And do you have any corrections to NMGC exhibit number 3, your direct testimony?
I do have one correction.
And why don't you walk us through that correction, please?
Yeah, certainly. On page 4 of my direct testimony, line 20, there is a number in there, $110 million. that number should be changed to $107.5 million. That essentially accounts for the 2.6 million or roughly 2.5 million that we received from one of our shippers. So that is not being charged to our existing PGAC customers.
Do you have any other corrections to exhibit number 3?
No, that is the only correction.
And if I asked you these questions, the questions in this testimony, as corrected, would your answers today be the same as in this testimony?
Yes, they would.
Mr. Hearing Examiner, I move for the admission of NMGC exhibit number 3.
One question before I go further. Was that correction that you made to the exhibit noted on the document that was sent to the court reporter yesterday?
Yes, Mr. Hearing Examiner, we provided a corrected copy of all of the testimonies. And so he has a corrected copy, redlined copy of all the testimonies.
And so did the commissioners then? I would assume.
Mr. Schanauer, yes, that's the same copy that I sent to the commissioners, the ones that they circulate. New Mexico Gas Company circulated with the corrections yesterday.
Okay, good. Thank you. Mr. Borman, do you have any objection to the admission of NMGC Exhibit 3?
I do not.
Okay, NMGC Exhibit 3 is admitted.
Mr. Shell, you have before you NMGC exhibit number 4. Do you recognize that document?
Yes, it's my rebuttal testimony in this matter.
And that rebuttal testimony was filed on May 28th. Is that correct?
I'll have to look to make sure here. Yes, it was.
Do you have any corrections to this rebuttal testimony?
I do not.
And is this rebuttal testimony prepared by you or under your direction?
Yes, it was.
If I asked you these questions today, would your answers be the same as contained in exhibit number 4?
Yes.
Mr. Hearing Examiner, I move for the admission of NMGC exhibit number 4.
Any objections?
No objection.
NMGC Exhibit 4 is admitted.
Mr. Shell, you have in front of you NMGC exhibit number 5. Do you recognize that document?
Yes, it's New Mexico Gas Company's response to initial order opening inquiry in this case.
And Mr. Shell, were you involved in the preparation of this document, or was it prepared under your direction and guidance?
Yes, it was prepared under my direction.
In fact, you verified some of the answers to these questions. Is that correct?
That's correct.
Do you have any corrections to the responses in exhibit number 5?
No, I don't.
If you were asked those same questions today, and or the people under your direction were asked those questions today, would their answers be the same?
Yes, they would.
Mr. Hearing Examiner, I move for the admission of NMGC exhibit number 5.
Objection?
No objection.
Okay, NMGC Exhibit 5 is admitted.
Mr. Hearing Examiner, strike that. Mr. Shell, you have in front of you NMGC exhibit number 6. Do you see that document?
Yes.
And what is that document?
That's New Mexico Gas Company's response to a bench request we received last week.
Very well. Were these responses prepared under your direction as the president of the company and submitted on behalf of the New Mexico Gas Company?
Yes, they were.
Mr. Hearing Examiner, I do have a correction that I just received 5 seconds ago to one of these tables. Mr. Hearing Examiner, I guess the best way to handle this is this. Let me propose this. The tables are going to be testified to by Mr. Yardley. So I wanted to get the exhibit in as being prepared and produced by the company. So this is a bench request to New Mexico Gas Company. So I wanted Mr. Shell to introduce the exhibit. And I think we've laid the foundation for that so we can get the exhibit in. I suspect that what I will do is, because the change is a change to table 2 to this exhibit, and Mr. Yardley would be the best one to make this correction when he gets on the stand, I can reserve the correction until we call Mr. Yardley, unless it comes up in a question. I mean, I can highlight the change right now, but Mr. Shell doesn't even know about this change. This is a change that Mr. Yardley has made to the table. So I can reference it right now for the information of the commission and the hearing examiner, but it really is, it's within the scope of Mr. Yardley to explain the change. How would you like me to proceed, Mr. Hearing Examiner?
How many changes are there?
Well, there's 3. They're on page 3, table 2, page 3. Table 2, page 3, the line that says average monthly impact, about halfway down, average monthly percentage impact under the rate 30 irrigation customers. See under rate 30 irrigation, the line average monthly percentage in those 3 percentages all change. The 2.6 becomes 4.7. The 2.2 becomes 3.9. And the 1.7 becomes 3.0. So it's 4.7, 3.9, and 3.0.
Okay, so you're proposing the admission of this exhibit as it is, with subject to the correction that you just described being discussed by Mr. Yardley when he's presented. Is that right?
Yes, Mr. Shanauer. I don't think Mr. Shell can validate that correction. I think that has to come from Mr. Yardley. So I would move for the admission of this, subject to Mr. Yardley's proving up that correction and indicating that the exhibit is true and correct as corrected by that last change.
Mr. Borman, do you have any objection to that?
I don't. I think this is probably the cleanest way to deal with this.
Thank you.
Okay, I'll admit.
NMGC 6, Mr. Hearing Examiner.
NMGC 6, subject to the correction described by Mr. Dome being further described and discussed by Mr. Yardley when he's called. But also, I'd also ask that the exhibit be, with that correction, be made into it, be sent to Mr. Lee to be incorporated into the record.
We will get that done as soon as we can, Mr. Hearing Examiner.
Okay.
They're working on that.
Okay. Okay.
Mr. Hearing Examiner,
Yes.
this is Commissioner Hall. I just had a question. Are we talking about Exhibit 6 to the application or something different?
We're talking about something different. We're talking Exhibit 6 to the application is part of NMGC Exhibit 1. This particular exhibit is the bench request response that the company provided just yesterday, I believe, to, I guess, Commissioner Fishman's bench request. I don't know, do you have that, Commissioner Hall?
Yes, I understand. Thank you.
Okay. All right. Do you have anything further for Mr. Shell, Mr. Dome?
No, Mr. Hearing Examiner, with that, those are the exhibits, and we will tender the witness for cross-examination.
Okay, thank you. Mr. Borman, do you have anything?
Thank you. Yes, I do have some questions for Mr. Shell. I believe most of these would be for Mr. Shell. Mr. Shell, if you think they're better answered by another witness, please let me know. With that, good morning.
Yeah, good morning.
You have your rebuttal testimony available. I think that's Exhibit 4.
I do.
Okay, and I'm trying to open the right document here too to make sure I have it. So on page 7 of your rebuttal, lines 1 to 3, you state that New Mexico Gas entered into an interim borrowing arrangement to pay the extraordinary gas costs incurred during the winter weather event. Do you see that?
Yeah, I see it.
What do you mean by interim borrowing arrangement?
Well, back in February and early March, after the storm had occurred, we knew we had incurred a substantial amount of gas costs and that we would not be able to pay it using our current debt instruments, our current line of credit. Thankfully, the commission rules anticipate these types of events and situations, and they allow for entering into loans that are less than 18 months to finance unexpected short-term liquidity needs. This was a substantial amount of money that we needed. We needed $100 million. We were unclear as to whether we could get $100 million in the course of 30 days. So we elected to take advantage of the commission rules on this and enter into what I'd call a short term. It's less than 18-month facility with one of our banks in our line of credit to essentially pay our gas costs, which were due on March 25th. So we viewed this as an interim step, because at that point in time, the most important thing that we had in front of us was paying these bills. And then moving forward, we didn't even know the period over which we were going to propose to collect these costs. We didn't know ultimately what the commission's decision would be. So we viewed this as kind of an interim step in this process.
So it was a loan.
Yes, it was a loan.
Okay. A short-term loan, less than 18 months.
That's correct.
Okay. From whom was the money borrowed?
We borrowed this from Scotia Bank, the Bank of Nova Scotia.
Okay. What was the interest rate of that loan?
Yeah, I have that here. So the interest rate was the LIBOR rate, the London Interbank Offering Rate, plus 65 basis points.
And so what is that rate?
Today, the LIBOR rate is very low. It's like 0.1%. So you add 65 basis points to it, it ends up being about 0.75% or 0.75%.
Okay. And when is this loan, I guess, due? When is it? When does this loan end?
We entered into this loan on March 25th, the day our gas payments were due. It is due on, I believe, September 20, well, I don't know the exact date, but around September 25th of next year.
Okay. And that would be just about the 18 months, correct?
That's correct.
Okay. Okay. Has New Mexico Gas provided a copy of this interim borrowing arrangement or loan into the record in this case?
I don't know.
Okay. So, and I think you stated that New Mexico Gas is seeking to recover a carrying charge in this proceeding, correct?
That's right.
Okay. And that carrying charge is different, or I guess maybe the accurate way to say it, it's separate and distinct from the interest that New Mexico Gas is incurring in the Scotiabank loan, correct?
That's correct.
And I guess what I'm trying to get at is you're not trying to recover both.
Oh, no.
Okay. And I think you say, and I think you've already kind of mentioned that on page 7, lines 3 and 4, that the carrying charge that New Mexico Gas is seeking is higher than the interest rate for the Scotiabank loan, correct?
That's correct.
Okay, and based on the numbers that you gave us, I think that would be borne out. That's correct?
Yeah, if you're comparing just the interim financing with our weighted average long-term cost of debt, yes.
Okay. I guess that kind of almost skips to my next question is New Mexico Gas's carrying charge. Well, let me ask it this way. Do you know when the commission approved the current carrying charge in New Mexico Gas's PGAC?
My understanding of how the PGAC works is that the carrying charges that are applied in the PGAC case come from our most recent rate case. So using that, the commission approved our rate case in December of last year. So the carrying charge utilized in our PGAC moving forward would be the carrying charge is determined in the rate case.
Okay, and I think the PGAC rider that New Mexico Gas has basically states the carrying charge at the rate of return established in New Mexico Gas's most recent rate case. Is that right?
That's right.
And the rate of return, that's New Mexico Gas's weighted average cost of capital, is that correct?
That's correct.
Okay. Are you familiar with the gas outage that occurred in, I believe it was 2011?
Yes, I am.
Okay. And are you aware, and if you're not aware, it's okay to say so, but if you are aware, did New Mexico Gas provide any financial assistance from its shareholders to its customers for damages caused by the arising out of the outage?
Yeah, we did. We did establish a fund that people could apply to receive money for things that perhaps weren't covered by their insurance. We would cover that. So yes, there was my recollection is it was $1 million fund that we administered for folks that were impacted by that event.
Is there any reason why the weather event of February 2021 should be treated any different than the event from 2011?
Well, I guess they're two very different events. In the event in 2011, we actually had to curtail service to customers. So customers were out of service for several days. Some incurred damage as a result of that. And so I think the events, while they were both cold weather events, were certainly very different in that regard. So we didn't turn customers off in this event. The system held up, the system performed well. All customers received their gas during this cold weather event. So while they were certainly both cold weather events, they were very, very different. And this one, of course, has the added complexity of a natural gas market that did things that frankly no one can really explain yet in terms of costs.
Okay. If you could go to page 8 of your rebuttal, I'll give you a second. And towards the bottom of that page, lines 18 to 22, you state, and I'm paraphrasing, that it would be unlawful for the commission to require shareholders to pay costs that were reasonably and prudently incurred on behalf of the customers in an extraordinary event. Is that correct?
Yes, as I state there, I'm not a lawyer, but my legal team has been reviewing all this, and it's my understanding in talking to them that that not providing for a carrying charge could be an unlawful taking. As I said, I'm not an attorney. I'm just simply, this is what was reported to me by my attorneys.
I understand. And I want to make sure, and you've kind of touched on it a bit, but I wanted to make sure that it's clear that this discussion here is in regards to the carrying costs that New Mexico Gas is seeking to recover in this case, correct?
Yes.
Okay. And those carrying costs are, by your admission, in excess of the interest charges that New Mexico Gas is paying. Is that correct?
Well, it depends on how you view it. If you take the interim financing in isolation, you could draw that conclusion. But the way we finance the business and operate the business and manage our long-term debt, we're actually trying to recover our overall weighted average cost of long-term debt. So when my finance team looks at their strategy around financing the long-term items of our business, they really look at the the debt in totality. And so that's, so when you say there's a difference, I don't know that there is necessarily a difference. It depends on how you look at it. My team tends to look at the long-term debt and financing long-term items as a bucket of money that's really there for financing all those assets.
Well, I guess what I'm asking is it New Mexico Gas's position that it would be unlawful for the commission to allow New Mexico Gas to recover only the interest charges that it is actually paying on the loan it took from Scotiabank, rather than the higher carrying charges that you're requesting?
Oh, I understand what you're saying now. I think, again, I am not an attorney, so I hate to even opine on this, but in discussions with my attorneys, I think the unlawful taking would have to relate to, well, I guess honestly, I'd have to confer with my lawyers on that.
Okay.
I'm not sure.
Okay. Let's move on to the next page. And you compare, I guess, New Mexico Gas's situation to that of Central Valley Electric Cooperative. Do you see that?
Yes.
Okay. Now, you're familiar with the organizational structure of Central Valley. Are you?
Yes, somewhat. I understand it's a co-op.
It's a co-op, and that means the owners are the same as the ratepayers. Is that correct?
That's correct.
Okay. And as such, you talk about the loan that Central Valley needed to take out to pay for its FPP, I think CAC costs. Is that correct? You see that?
Yes.
Okay. And seeing as the ratepayers and the owners are one and the same, I mean, it's true that the Central Valley ratepayers are responsible to pay the interest on the loan that the cooperative has taken out, correct?
Yes.
And it's also true that the Central Valley owners are responsible for paying that. Is it correct?
Yeah, that's my understanding.
Okay. And now, as you state in your testimony, Central Valley was authorized to recover the actual interest charges that it would incur as a result of the weather event. Is that right?
Could you repeat that? I'm sorry.
Well, you say Central, and it starts on line 6, Central Valley sought to recover approximately $190,000 of interest charges it will incur due to emergency loan Central Valley need to pay for FPPAC costs.
Yes.
You see that?
Yes.
Okay, so they're seeking to recover the actual interest charges that they're paying, correct?
Yes, it looks like in this case they're actually requesting the actual interest cost and not a carrying charge rate.
Okay, and at least from this testimony, there's certainly nothing in here regarding Central Valley's, I guess, cost of debt, outside of this this loan that they obtained. Is that correct?
Yes, that would be my understanding.
Okay. Well, let me ask you this, and I'm getting to the end here. Does an event like the February 2021 extreme weather event create any additional operating risk to the utility?
Yes, the event itself, is that what you're referring to, or the finance?
Yeah. Well, the event.
Well, yeah, I think it does. Clearly we incurred a significant amount of costs. We would like to avoid that moving forward. So I think, part of what we're doing after this event is taking a real hard look at everything in our business to determine whether there are any opportunities to prevent this from happening in the future. So, we're looking at a whole wide variety of things, including our gas supply contracts, potential different ways to hedge. These are all things that Mr. Tilbury can talk about. We're also looking at maybe completely different ways to operate. Storage and storage facilities are obviously very important, and that was proved true in this event. Our current storage facility provided an immense amount of low-cost gas to our customers during this event when market prices were very high. But that same storage facility also had a force majeure. So it did provide extreme benefit, but it also didn't supply all the deliveries that we were hoping for. So yeah, we're looking broadly at the business for opportunities to maybe change the business to prevent or lessen the impact of an event like this should it occur in the future. We're looking at storage very broadly. We're even looking at like LNG storage, liquefied natural gas. We think that owning and operating a storage field ourselves may provide more flexibility and better reliability. So yes, there's a number of things that we're looking at as a company that operationally could help us moving forward.
Okay, and that operating risk and the costs relating to that operating risk. I mean, is it fair to say that New Mexico Gas's request in this case is seeking to pass along those costs to the customers?
Could you repeat that question? I'm not sure I understand.
I probably worded that poorly. I apologize. The request that New Mexico Gas is making in this case for carrying charges, that is basically, that seeks to pass along to New Mexico Gas's customers the costs of the operating risk that the February 2021 weather event created for the company. Is that correct?
No, it's passing along, I guess, the financial risk is how I would view it. The financial cost to the business, the loan cost or debt cost, weighted average cost of debt.
Well, the loan costs are the cost of the financing the loan with Scotia Bank, aren't they?
Yeah, that we took that loan out, and now it's part of kind of our broad, large bucket of debt outstanding. We had 300 and roughly 80 million of debt outstanding. This increased that outstanding debt by another 100 million. So we have 400 and roughly 80 million dollars of outstanding debt now, financing various long-term items in our business. Typically, the way we handle that in both rate cases and in carrying charges is you compute a weighted average cost of long-term debt. That becomes your rate of return in a rate case. It becomes potentially your carrying charges for various regulatory mechanisms as you move forward between rate cases.
Okay, thank you. I have no further questions for Mr. Shell. Thanks.
Commissioners, do you have any questions?
Mr. Presiding Officer.
Yes, go ahead, Commissioner Maestas.
Thank you. Good morning, Mr. Shell.
Good morning.
I had a fundamental question about kind of the total financing. It seems that the short-term loan is 100 million, but you incurred 110 million. Obviously, that's been revised since you recovered a portion of it. But for the amount above the 100 million short-term loan, how much is that, and how will it be financed? I guess it would be 17.5 million. No, that would be 107. Anyway, how will you finance the difference, between the difference between the total amount due and the $100 million short-term loan?
Yeah, Commissioner Maestas, thank you for the question. That actually kind of fundamentally gets to maybe the issue in the case. So we took out 100 million because we felt that's what we needed. I realize we incurred more costs than that, but we can absorb the difference just through our other financing activities in the business. That's a, that can be, the shareholder has put equity in the business. We have a line of credit. We didn't want to take out the full amount of the gas cost if it wasn't required. And we had means within the business to pay that difference. So it's just, I can't point to any particular loan or piece of equity. That's kind of the central point here, is that once funds are in the business, it's hard to trace it to specific assets necessarily. So those funds came from our other operations, is I guess how I would characterize it.
So would you consider it to be a concession on the part of the company to minimize cost impacts to your customers?
I suppose you could view it that way. I actually view it, I view it as it was just the right thing to do. We didn't need to borrow the full amount, so we just borrowed 100 million. We try to manage our debt that way. We try to minimize our outstanding debt and really only incur the debt we need in this instance to finance kind of our long-term items. And certainly the recovery period for these gas costs is a long-term item. So.
Okay, thank you. In Exhibit 1, page 24, paragraph 6.
I think you're looking at the application, is that right?
Yes.
And I'm sorry, what was the page number? 6?
Page 24.
24, okay.
There's a statement that says, finally, it would be extraordinarily difficult for the company to attract sufficient capital to cover more than $110 million of expense over a 30-month period without a belief by lenders and the shareholders that the company will be able to recover the full expense, including the cost of financing the 2021 winter event cost in a way that is designed to decrease the impact on customer bills. So recovery of the company's average cost of debt, I think it goes on to say, I'm jumping around a little bit. Recovery of the company's average cost of debt is the best, most reasonable approach to providing enough certainty to allow the company to handle this extraordinary obligation in a reasonable manner and preserve its ability to finance its operations into the future. So in an effort to really understand the impact on your credit, is the company's credit rating based more on cash flow and meeting existing obligations more than total debt levels? And if so, how would applying the gas company's actual financing costs on the 110 million short-term loan risk a negative effect on the company's credit rating? So could you kind of explain kind of the impact on debt?
Yeah, I guess so. The credit rating agencies look at a wide variety of things. They certainly look at outstanding debt. I think we would all understand that the more debt you take on, the riskier the business is. They also look at cash flows and ability to meet certain obligations. So they'll look at things like cash flow from operations, our overall interest cost, the ratios of our cash flow from operations to interest costs. They want that number to be relatively high. So there's a whole variety of things they look at when setting our rates. For utilities, commission orders and recovery of costs are obviously important as well. So I can't say that I could pinpoint any one thing they look at. It's a whole wide variety of things they look at. I've never worked for a rating agency, so I can't get into all the details, but there's a wide variety of things they look at. So I think that answers your first question. Remind me again what your second question. I think you had a second question.
It was, if so, how would applying the gas company's actual financing costs on the 100 million short-term loan risk a negative effect on the company's credit rating?
Okay, all right. Yeah, I don't know that it necessarily would. Credit rating agencies are a third-party organization, so I don't know with certainty how it would impact them. Ironically, we think we may be getting a rating update from Fitch at any time now, perhaps even in the next few days. But because we went through a review with them here a couple months ago. So we put forth what we gave them our application in this case. And so they had that material with them. I would venture to guess right now, and maybe I shouldn't even venture to guess. Let me stop there. I shouldn't be guessing when I'm testifying.
Mr. Shell, what we've seen in recent previous similar cases, lenders have placed restrictions on the borrowers. So has the Scotia Bank placed any operating or capital investment restrictions on the company as a result of this short-term loan?
I think I don't know with certainty, but I think in some of the other cases that you've heard over the last couple of weeks, there were mortgages placed on assets and things like that. This loan does not. It's not a mortgage, so it doesn't place a lien against our assets. If that's the main point you're getting to, there are certain covenants that are in all our debt instruments. This term loan, the terms were based on our outstanding line of credit. So it follows very, very closely, if not exactly our line of credit, because the bank that we went through, the Scotia Bank, was also a member of our line of credit banks. So the terms, I guess what I'm saying is the terms are no different than the terms we were operating under before this event. So I don't know if that answers your questions.
But there's no other covenants that say, well, if you incur additional debt, you have to inform the Scotia Bank, anything like that, that kind of curtails your ability to incur additional debt, whether it's capital investment or otherwise.
Yeah, there are limits on incurring debt, and those limits are present in all of our banking facilities. The terms are very similar across all our banking agreements, because no bank wants to be behind another bank. So these lending agreements are often set up very much the same way. So there are limits on the amount of debt we can take out. We can't, for example, our debt can't be more than 65% of our total outstanding capital.
Okay, thank you for that. I have a question for you. Is the New Mexico Gas Company open to the commission authorizing recovery of the known financing costs for the first 18 months and conditionally approving recovery of financing costs incurred following a competitive procurement on later financing? Because obviously the recovery period exceeds the 18 months in the short-term loan.
Mm-hmm.
Would the gas company be open to that?
Well, yeah, we'd be open to that. I guess I might just make a couple comments on that. We chose the 3.7% because essentially it's the normal practice, as I understand it, when you're setting carrying charges for recovery mechanisms such as the one we're talking about. So you look back to your last rate case, there's a known number there. You use that number because it's a fairly close approximation to what your weighted average long-term debt rate is. So that's the normal practice. I would also say that just remind the commission that we do view this as part of our broader financing strategy. So it is now intermixed with all of our long-term debt. And if, for example, we may ultimately determine that it makes a whole lot more sense, instead of just refinancing this for 2 years, to refinance it for 10 years, because in the overall scheme of things, that may be the most advantageous thing for our customers long term. We don't want to view this as what's most advantageous for the next 30 months. We want to view this as what is the most advantageous for the next 20 years. So anyway, we just have to view this in broader context. So I just want to mention that to you, Commissioner Maestas, and the other commissioners. I would also just say that we have taken on a lot of extra risk here with this particular debt. So anyway, I've said a lot there, but my point is, I just want you to be aware of some of the way we're thinking about things. But also just tell you that, no, we're not opposed to that if the commission were ultimately to go there.
Okay. I believe you stated that the terms of the short-term loan is that it's a floating rate. Obviously, it's very low now, but it can go up. We're seeing signs of potential inflation and maybe the increase in interest rates of some of these debt instruments. If favorable terms are available for the New Mexico Gas Company to refinance at an earlier date to free up its line of credit and capitalize on current low interest rates, would they be willing to do that instead of, my concern is if we wait 18 months and then we look at another debt instrument that may be more stable and secure, rates could go up in that intervening time. And I wanted to entertain the possibility of perhaps within 3 months, seek alternate debt instruments that could provide more certainty in terms of your level of debt throughout whatever the recovery period is, whether it's 30 months or a different period.
Yeah. Commissioner Mastis, other commissioners, you're exactly right. In fact, I've been talking with my vice president of finance, and our goal is to very quickly take a look at all of this and determine what the best course of action is. The first step is essentially to get through this hearing and have a firm understanding of what the commissioners want us to do. But ultimately, I want to work with a bank to potentially do some long-term debt. And it may not be for the full 100 million. We'll have to, we'll look at what is in the best interest of customers long-term. But yes, I know exactly what you're saying. Rates are probably at historic lows right now. We issued some of our lowest rate debt just in the last 12 months. So it's a great time to be in the market. And certainly we want to think about the long-term picture for customers. And it may make a whole lot more sense to refinance sooner rather than later. So that's why earlier when I said this is really part of our overarching broader financing strategy, that's what I meant, is that while we have this right now, we may not have it in 2 months. We may decide that it makes a whole lot more sense for customers to refinance quickly.
So can you offer the commission maybe a recommendation of perhaps revisiting the outcome of your assessment of refinancing this debt within a very short time frame, let's say within 3 months? Or do you still recommend that you continue with the 18-month short-term loan, and then perhaps at 18 months or 17 months, you will present an alternate form of debt financing throughout the remainder of the recovery period?
Yeah, no, I could, if we were to refinance this debt, whether we were to come forward in a couple of months or in 18 months, the process, especially if it's long-term debt, the process would be that we would have to come for commission approval. So that isn't unusual and would be the normal course for us.
Okay. Mr. Presiding Officer, instead of, I'm done with kind of the financing related questions, but do you suggest that I just go on and finish all my questions, or do you want to handle it by area? Because there could be other questions regarding financing. Do you have a preference?
I'd suggest that you ask all the questions you have of this witness.
Okay.
Yeah.
All right, thank you. Mr. Shell, in your rebuttal testimony, exhibit 4, page line 17 through page 6. So page 4, line 17 through page 6, line 5. And it states that NMGC, like other utilities in similar recent proceedings, opposes a monetary cap on the amount of gas costs that may be recovered by customers in the current case and in future cases. But the commission may need a policy tool to ensure gas purchase costs, or for example, financing costs, are minimized in the future. So my question, Mr. Shell, is is the New Mexico Gas Company opposed to a PRC requirement? I'm sorry, does the gas company have any suggestions on how the PRC can do that?
Excuse me, could you tell me that page and number again?
It's Exhibit 4, page 4, line 17 through page 6, line 5. And let me just restate it. It states that the gas company opposes a monetary cap on the amount of gas costs that may be recovered by customers in the current case and in future cases. But the commission may need a policy tool to ensure gas purchase costs are minimized in the future. Does the gas company have any suggestions on how the PRC could do that?
Mr. Presiding Officer, Commissioner Mastis, I apologize. I am not following where you're reading. And you're on page 4 of my rebuttal testimony, starting down on line 20. Is that where you're at?
Page 4, line 17. Let me find it that way. I hope my reference is correct. Exhibit 4. Well, actually, Mr. Shell, that's not a quote. It's kind of a summary of your answer in that. So instead of, it's not a specific quote.
Okay, all right.
But does the commission need a policy tool to ensure gas purchase costs are minimized in the future? And do you have any recommendations or suggestions?
Well, I think this question, as I read it, related more to the way I read it, at least, was disallowing, and maybe I read into it improperly, but essentially disallowing gas costs. And so I would disagree with that. Obviously, I think we incurred our gas costs prudently and properly. So I didn't like the fact that I thought it was suggesting that we limit the amount of gas we can recover, even if we incur those costs prudently and properly.
Okay. Mr. Shell, one thing that we're discovering as we're hearing these different cases, and there have been a variety of debt instruments used to finance the cost for excessive gas required on the open market, or excess gas required on the open market. Is the New Mexico Gas Company opposed to a PRC requirement for competitive procurement of financing for gas purchases on the open market?
Competitive procurement, I thought you said of gas financing costs, but are you just referring to gas costs?
Basically soliciting bids for financing for the $100 million. I mean, you went to Scotiabank. It's not clear whether you did seek bids to try and acquire the lowest financing cost for your customers. And we're finding that other companies are basically, either going with the bank that they normally go with, or, it's a kind of a familial thing. But I, as a commissioner, am concerned that perhaps there should be a more formalized process to seek competitive bids for financing, especially when we're dealing with these excessive costs for gas purchased on the open market. I realize this is an extraordinary event, but who knows, we may experience a similar event very soon. So what are your thoughts on that?
Yeah.
On competitive procurement of financing?
Yes, certainly, Commissioner Mastis. I thank you for clarifying that. I was getting confused by the question, but now it's perfectly clear. And so I apologize when I talked about the loan with Scotiabank earlier. I didn't elaborate on the process. So Scotiabank is part of what we call our relationship banks that know us really well. They understand our business. We work with them very often. You usually get very competitive rates from your relationship banks because they don't have to do a lot of work to understand the risk of your business. So we have a number of relationship banks in our line of credit facility. I don't know the number, but it's anywhere from, I think, 8 to 12 banks in that facility. What we did actually was we approached 3 of those banks and asked them how they could finance this. And so Scotiabank of the 3 was actually the lowest. So our Treasury Department spent a lot of time back and forth with Scotiabank, Wells Fargo, and BMO. And ultimately, Scotiabank was the lowest price for financing. So we did go through a process. It was a bit informal. It was mostly over the phone because I think you probably have obtained a mortgage or something like that yourself. A lot of it is just calling and discussing with your bankers, your known bankers, what they can offer. And that's what we did. So we, in a sense, in my opinion, we kind of did do a process like you're mentioning.
Thank you. I think that really helps. And for the record, to demonstrate that the New Mexico Gas Company did engage in a responsible search for the lowest possible financing. But right now, our Rule 640 is silent on addressing any kind of incentives or encouraging some kind of open procurement of financing costs to ensure that that companies such as New Mexico Gas do secure the lowest possible financing. So thank you for explaining that, Mr. Shell. My next questions pertain to gas strategy and some of the pending inquiries with Kinder Morgan regarding the storage agreement. Mr. Shell, do you think I should direct that to perhaps Mr. Tilbury?
Yeah, that's probably, he would be far more familiar if you want to get into a deep discussion around that. He's far more familiar with those contracts than I am. So that would probably be a good thing.
Okay, thank you, Mr. Shell. Mr. Presiding Officer, those are all the questions I had for Mr. Shell. Thank you.
Okay, thank you. Do any other commissioners have any questions?
Mr. Hearing Examiner?
Yes, Commissioner Vicente Aguilar, go ahead.
Yes, I would like to ask the president of New Mexico Gas Company.
I'm sorry, Judge, I can barely hear.
You were breaking up.
Question, can you hear me now?
Yes.
My question is, I would like to know how many customers New Mexico Gas Company currently has on record. You don't have to give the accurate number, but give us a ballpark number.
Certainly, Commissioner Vicente Aguilar, thank you for the question. You're right, I don't know the exact number, but I believe we have about 540,000 customers.
Can you explain to me the areas New Mexico Gas Company has customers? You may indicate counties or by region.
Yes, certainly. We actually, Commissioner Vicente Aguilar, we have operations throughout the state. I think the 2 LDCs that were in for hearings before us have small areas in the state. We largely serve the rest of the state with the exception of a few, a municipal gas utility down in Las Cruces, and I think there's a municipal utility in Silver City as well. So by and large, we are in nearly every corner of the state. We're located throughout the state. We have operations throughout the state.
I understand that you have been with the company for approximately 6 years. Is that correct?
I've been the president approximately 6 years. I've been with the company 12 years.
Okay, so giving us a perspective of the company's future. Can you share with us your knowledge and your strategy of storage facilities? I understand that you want to turn that over to another witness, but as the president of the company, I think we need to hear from you what your strategy is as far as minimizing costs for your customers and how you can minimize projects in the future. Can you explain that to me, please?
Yes, Commissioner Vicente Aguilar, thanks for the question. I'd be happy to do that. Yeah, we are in the midst of an evaluation right now, really, of our storage operations, whether it's leased storage like the Kinder Morgan facility we have right now, or other opportunities for us that could range from underground storage to liquefied natural gas storage here somewhere in the state close to our load center. Those evaluations are very early stages and being worked on right now. But yes, storage is a critical piece of a gas utility and obviously very important in events like this. So that's why we're taking another look at this. You may recall, Commissioner Vicente Aguilar, that we've looked at LNG in the past and ultimately decided not to pursue LNG and instead work with this underground gas storage facility in West Texas. But we're reevaluating all of that because storage, quite frankly, is a critical piece of our operations, and we want to make sure that that the company is positioned to provide the best value for customers and the best reliability for customers. And in light of this recent event, to be able to limit potential price increases by pulling gas from storage. So there's a fair amount going on right now around that, and I will let you and all the commissioners know that if we reach some conclusions here in the near future or this year or next year or whenever, we will bring that forth. If we decide to go with LNG or some other form of storage, we will bring that forth to the commission for approval because it would be a pretty major major thing if we were to undertake that. So there's a lot happening around that right now, and I would say that there's a high likelihood that we're going to be bringing forth something for commission approval around that.
Thank you for your answer. One last question. The event that occurred in February of 2011 to the current year, February 2021, that's approximately 10 years. During the 10 years, did New Mexico Gas Company put in place a strategic plan for storage facilities, gas storage facilities? Because New Mexico Gas Company is very well aware how, when an event happens, they need to make decisions instantly. And I don't see why New Mexico Gas Company did not plan for another drastic weather event for so long. And I would like to, I will study that during this hearing, and maybe you can fill in your response, why it's taken very long. Thank you.
Yes, certainly, Commissioner Vicente Aguilar, other commissioners. You're right. There wasn't a similar event, while very different. It was similar in terms that it was a weather event in 2011. So approximately 10 years prior to this event, we actually have done a large amount of improvements to our systems since 2011, which frankly may have made a difference between, in 2011, we had to curtail customers. And in this case, the system held up remarkably well because of all that we've done to the system since 2011. So we took our learnings from 2011 and essentially expanded our system in a number of ways and improved our system in a number of ways. we looped our Rio Puerco main line, the line that runs from the interstate pipelines southwest of Albuquerque and brings gas into Albuquerque. We looped that line, added a much larger line there. I think you all may be familiar that we looped the Santa Fe main line last year. And if anybody drove to Santa Fe last year, they probably would have saw that work along I-25. It was a very big project where we put in 35 miles of large diameter pipe. So those two things added a lot of line pack to our system. We also added compression to our system. We reevaluated and changed how we did some of our procurement practices, particularly for swing gas. We did add storage. We did increase our storage in West Texas. However, we recently reduced that slightly because of all these other improvements that we had done. So there was a wide variety of system improvements that we did in that 10-year period that, in my opinion, helped drastically in this event, because we experienced on Valentine's Day, that was the Sunday, New Mexico, that was the coldest day in New Mexico, was Sunday. Now the pricing event carried on for several days after that because of issues in Texas. But on that day, Valentine's Day, I think it was February 14th or 15th, that was our fourth largest throughput day on our system ever. And I will be frank, and Josh Tilbury can talk about this too. The system held up remarkably well, commissioners. We saw the line pack kept its pressure high. The deliveries were fine. Everything went very well, and we didn't lose a single customer. So, and it wasn't like it was close. I mean, the system held up very, very well. It wasn't like we were within hours of losing customers. The system, the pressures, everything held up very, very well. So very happy with what we've done in the past 10 years based on what we learned in 2011. So we have done a fair amount in that time period.
Mr. Shell, thank you very much for your responses. Your answers helps me make a better decision. Thank you.
You're welcome.
Do any other commissioners have any questions?
Yes, Mr. Presiding Officer.
Yes, go ahead, Chairperson Fishman.
Mr. Shell, during this emergency, I'll call it, what efforts did New Mexico Gas make to contact customers to perhaps lower their usage and save money, knowing that these gas costs were so high?
Chairman Fishman, thanks for the question. We did do social media report outs. I don't know the specific dates. To be honest, I'd have to. I don't have that in front of me. But we did, in the middle of the event, we did post to social media and ask customers to curtail. At that point, it was this was an interesting event because we didn't feel that we were in a situation where we may have to curtail customers. So normally we would not have issued any sort of statement like that. But when it became apparent that gas costs were very high, and it became apparent that gas costs were going to be high for a while based on what we were hearing out of Texas, we then realized, okay, we're not likely to lose any customers. When I say lose customers, I mean curtail customers. But there's clearly a pricing issue going on. We did post on social media through our communications department. This essentially telling customers that no need to worry. No one's going to be curtailed. But if you're able to reduce your usage, that would be helpful.
Did you do any public service announcements over broadcast?
No, we didn't. We did it mostly through social media.
Okay. And in terms of social media, you've got 500,000 customers. In that short period of time, what kind of uptake would you normally have that people actually see that social media message?
I don't know how many people view our social media on a daily basis or come to our website on a daily basis.
Mm-hmm. would you say that it's a fairly small percentage, just ballpark? Would it be 1%, 10%, 100%? Which would it be closest to?
Which one would be closest to? Chairman Fishman, this would be a guess on my part, and maybe I shouldn't do that while testifying, but maybe 10%. I don't know.
Okay, thank you. And then if this were to happen again, what would you do differently in the future? If you saw something coming up, would you have maybe a more proactive approach to protect customers from the cost? And is that something that you're discussing?
Well, there's a lot of things that we're discussing, Chairman Fishman. It's interesting in this event, protecting customers from costs. We are looking at all of those things. I think what I don't want to read into your question, but are you asking about doing more communication so they may reduce their usage? Is that what you're asking, or other ways to?
Yeah, more communications, or would your policy be to, perhaps take a more conservative approach and say, this might turn into something bigger, so we're going to warn customers now, rather than reacting after the fact?
Yeah, it's Chairman Fishman, that's an interesting question. We've had interesting things happen in the past around that. I think in 2011, when we asked customers to conserve, it appeared that usage actually went up. So people react funny to those types of things. So I would say that we could, every time a storm comes, put out public service messages. But then, we could be doing that multiple times a year. And it always becomes hard to know when exactly to do that, because if you're doing that multiple times a year, do people just get used to it and kind of ignore it? So we tend to wait until we have a known issue in front of us, because otherwise, if you're sending out those types of warnings 5, 6, 7 times a year, well, the one time it's really important, people are so used to listening to it, they just may not react the way you want them to. So anyway, it's a great question, and there's a lot of psychology in that question in terms of how people react to it.
I understand it. Thank you. That's a helpful answer. So I'm going to go back to the financing for a minute.
Sure.
When you got the financing, was the bank aware of the specific reason that you were getting the financing?
Yes.
Okay. And you've got the financing at what, today would be a 0.75% interest rate with today's LIBOR. Is that correct?
It's hovering right around 0.75%. So we're very pleased with that rate.
Okay, yeah. So first of all, I want to say congratulations. That's a very low rate, and I appreciate the fact that you guys were able to get such a low rate. I think that's good for everybody. Did the bank explain your normal rate is, well, let's try this. Right now you're saying your cost of debt, long-term debt, weighs in at about 3.7%. Is that correct?
Yes, that's correct.
Okay. So that's a difference of 3%, approximately 3%. We'll just use that for rounding. Let's assume that 0.75 interest rate stays flat. And I know that's a big assumption, but just to get some rough figures here, what would be the extra cost to consumers over, let's say, the 30-month that you're recommending, of charging your cost of debt, your weighted average cost of debt?
Well, that depends on a wide variety of factors. So,
Yeah, how fast you pay it down, and
yeah,
you
exactly.
know, I understand, but
Yeah.
would you say that it's it would pass on an additional $3 or $4 million? Depending on all kinds of factors. It could be 3 years. We might decide on 4 years.
Mhm.
But,
Yeah, I guess it's hard for me to answer that question specifically because I haven't done any calculations around it. And it depends on such a wide variety of factors, like if we refinance in the next few months, or there's a variety of things that could impact that.
yeah. But
And
again, I'm just saying, assume it stays at 0.75% for 3 years. And that's what we decide. It would cost at least a couple of million extra dollars to consumers. Would that be a reasonable thing to say?
Yeah, I guess what you're asking is if whatever debt's in place, it remains at 0.75.
Right.
Yeah. Yeah, I haven't done that calculation, so I can't. But I think you're probably right. It's probably a couple $1 million, but I haven't done the calculation, so I'm unsure exactly what the dollar impact would be.
Okay. In terms of you got that low interest rate, shopping it around, and was there any discussion about why the bank was willing to loan at such a low interest rate?
Well, as I said earlier, it is a bank that's in our current line of credit facility, or what we call our revolver. So they're very familiar with us. They receive periodic financial information from us, and they know our business. Our parent company, Emera, meets with the banks in our banking syndicate regularly. So they're very familiar with not only us, but Emera, our parent company. So the one thing in the financial world that is very, very true is that scale makes a really big difference. And the bigger companies are, the better the rates they get. So New Mexico Gas Company, is a large company here in New Mexico. But in the world of utilities, we're not that large. So being part of the Emera family of companies, I have no doubt that that impacted our financing here. And we were able to get a really low rate because Emera is a very large company.
Could you spell Emera?
EMERA.
Thank you.
So the bank must, to give you that low rate, they must feel very confident that you're going to be able to repay. Would that be a correct statement?
They're comfortable with our financial position, and as I said, we're part of a much bigger organization, and I think they're comfortable with that organization overall.
And did you have specific discussions about how you would repay? How you would get the funds to repay?
I wasn't a party to the specific discussions, so I guess I can't answer that. It was handled by my Treasury Department.
Mm-hmm. But it was known by the bank that this loan was specifically to handle this emergency.
Yeah, they were well aware of the fact that we had a liquidity issue with our gas bills, and that's why we needed the funding.
Okay, thank you. Did any of your terms on any of your other debt instruments need to be changed, or were any covenants on those instruments invoked as a result of taking out this additional loan?
No, nothing changed in our other debt instruments. As I said earlier in answer to a question, our debt instruments are actually very, very similar in terms of the language and the covenants.
And if these rates remain so low, and I'm taking a kind of approaching this issue from the other side of what Commissioner Maestas was asking, if these rates stay so low on this kind of loan, would you consider re-upping on a similar instrument after 18 months?
Yeah, that's part of our evaluation. So this instrument, this loan, is now part of our overall kind of long-term finance. Even though it's a short-term loan, it is actually baked into our strategy and how we're handling kind of our long-term financing. It is an intriguing rate, and the question is, will it remain there? So that's really part of our evaluation, and we'll work with outside financial experts and different folks to really look at that question, because we could land in a number of different places. We may want to keep some debt variable like this. We may want to take some debt and make it long-term. It'll depend on kind of what the financial experts tell us around where they think rates are going, because if rates suddenly rise multiple percentage points, and that'll impact what we're paying for this interest rate. And also, if we believe inflation is upon us and long-term rates are going to rise, and we have a need for long-term financing beyond this period, then there may be reason to get a loan for beyond this period as well, because we want to, of course, lock in our lowest rates possible for our customers. So all of those things have to be taken into consideration. But I think getting back to your original question, would we consider that? Yes, that would be part of the consideration, keeping a variable rate outstanding. But we would have to really look at what we think is going to, it's hard to predict what's going to happen in the future, but we rely on experts to tell us where they think interest rates and inflation is going. And ultimately, we as an organization here, we will make a decision around what we want to do with this loan, how we want to refinance it. And as I said, we'll bring that forth to the commission for approval.
Okay. And in making
Mr.
this,
Chair, excuse me for one moment. Could I just ask the witness to raise his voice or sit closer to his microphone? I'm having difficulty hearing his answers.
Okay.
Thank you.
Thank you, Mr. Shell.
Commissioner Hall, I'm sorry about that. I'll try to speak up.
Thank you.
So I had a question there and I just lost it. Oh, I know what it is. And as you're making this filing, you're making it under the extraordinary event section of our rule. Is that correct?
Yes, that's my understanding.
And as I look at the areas where you cited your cost of debt being used as needing to be recovered, all the other cases that you cited there were more in the normal course of business, as I understood it. Would you say that's correct?
Yeah, that's a fair statement. It's our normal balancing account mechanisms and recovery mechanisms, and our normal rate case rate of return calculations and things like that.
Okay. So as I'm looking at it, and critique this statement for me. This is an extraordinary event. Therefore, the way that we look at the debt and the recovery of interest on debt, because it's extraordinary, might be different than the norm that we use, the weighted average cost of debt.
Chairman Fishman, that's a fair statement. You as commissioners are certainly well within your authority to decide that this needs to be treated different. I think what we put forward, well, I know what we put forward was kind of the normal process. We believe, or the normal carrying charge that would normally be charged in instances like this, or with normal recovery mechanisms. We feel our risk have increased significantly, and that's a reasonable thing to do in this case. So 2 months ago when we filed this application, that was the position we took.
Okay, thank you.
But I agree. What you're stating is not unreasonable.
Okay, thank you for that. I said, I saw your response to the bench request, and I haven't had a chance to read the last order your last draft order. But in terms of the specific rates that were developed, should I be asking you, or better to wait for another witness?
Yeah, I'm familiar with what we filed here and was aware that it was being worked on over the last couple of days. I was handed a copy of it this morning. The person that who could probably answer these questions very, very easily is New Mexico Gas Company witness Yardley. He's our consultant in this case. He's our rate design expert. So he is very, very familiar with this.
And in your solution, since I haven't had a chance to read that latest draft order that you guys sent us, did you make a recommendation on which of the scenarios to use, or not? You left that open?
I can jump in, Mr. Chairman. No, we did not. Not in that. We did not put that recommendation in that.
Okay.
I'm sorry, who was speaking?
I'm sorry. This is Tom Domi.
So I will ask a couple of questions of you, Mr. Shell, on it, just to, in having reviewed I guess there's three, and let's just take out the dimension of timeline, 30, 36, or 48 months. There are essentially three proposals in front of us. Your original proposal, the one I asked for in the bench request, and then you guys, and thank you very much for doing this, then generated a third option that you thought might be preferable, or at least you wanted us to consider.
Mm-hmm.
Of those three options, do you have a preferred option, one that you like the most?
Well, I haven't probably studied them as much as I should have here, but I guess what I would tell you is, we rely very heavily on our rate design expert, Mr. Yardley.
Okay.
I think he's the one that recommended the final option. So I would stand behind that option. He does work all over the United States, and this was an option he put forth that he thought made sense as a rate design expert. So I would stand behind what he proposed.
Okay, well, I'll get into that in more detail with him. But just let me say thank you very much for being proactive in making sure we have a good set of alternatives in front of us, and that you're looking to improve on whatever crazy stuff we ask you for as a commission. But it makes me feel like we're working together on that stuff, and I appreciate your being forward-looking on that, and that's all my questions. Thank you.
Thank you, Chairman Fishman. And I might add that we're appreciative of the commission and expediting this hearing and handling this yourselves. I really appreciate that. It's good to interact with you and answer your questions directly.
Okay, are there any other questions from commissioners?
Mr. Hearing Examiner, I just have one or two questions.
Commissioner Hall, go ahead.
Okay. Good morning, Mr. Shell.
Good morning. Good morning, Commissioner Hall. Nice to see you.
So I think that most of my questions are completely covered by the other commissioners, but something that you were asked about and answered, I just wanted to go into a little bit, and that was the extent of public outreach the company performed in advance of the cold weather event. I mean, you said you did some social media, but no public service announcements. And I guess I was just reflecting on that because to the extent your customers could have heard from more than one source, and I can't imagine in the 500,000 plus customers you have that they all use social media. It would have been nice to hear from other sources. And I remember noticing in the news warnings about the weather, 4 or 5 days in advance about the possibility for really extreme temperatures. And I believe you did say, you would consider others. I'm not actually sure, but you did provide some reassurance about improving, your outreach to customers in advance of whatever other new extreme weather event may be coming around the corner next winter or the next. But I just wanted to ask, do you think that would be something to get on top of, before the next winter shows up? I mean, and I'm not saying, I don't want to be too doomsday about it, but, California used to occasionally have fires, and, for the past 2 years, they had them one right after the other, 3 years, I think. So that were really severe and did force outages. I mean, it's really admirable that you guys didn't have outages, but I don't think we can expect it'll always be work perfectly like we would like. So could you just speak to what you might do to inform your customers in advance that this is based on information like we got this last time, that you would encourage them to curtail? I mean, I think that's one. If it's done voluntarily, customers I don't think are nearly as upset as when it's done involuntarily. So I wondered if you could just tell me what your thoughts are from a corporate perspective in terms of trying to address this part of the equation.
Well, thank you, Commissioner Hall. In terms of communication, I think as we look at this event, we probably, in hindsight, maybe we should have did more public service announcement to get it more widely spread. So that's probably a lesson learned here that we will work on. Because we posted on our website, we did social media. There may have been some other things, but they were primarily social media type based things. I would agree that we probably could do some work there to make improvements before the next event like this hits. I talked earlier about there's a real fine line there between making too many of these announcements and having the public get used to it, and then they are not as effective as you might want them to be. So there is a fine line there between just how that gets done. But I want to make sure I understand kind of the second part of your question. I think you were asking about curtailing customers, or asking customers to voluntarily curtail. When you mean curtail, you mean completely turn off gas, or are you saying reduce usage? Reduce
usage.
Oh, okay. Yeah. Okay. All right. I understand now. So I think that's answered in the first part of my question. So yeah, we try to learn from all these types of events, as all organizations do. And as we look back at this, maybe we should have did more wider notification about what was happening. As I said in answering the previous commissioner's question, we didn't feel, you normally do that when you think there's a possibility that you're going to have to curtail customers and turn customers completely off. That has been when people normally do that in the gas utility industry. So we didn't foresee that in this instance, and it wasn't until we realized there was a huge pricing issue going on. Once we realized that, then we did do the notifications. But you are correct. We just did it mostly through social media and our website and areas like that, and we could probably expand that and do a better job in the future.
Expand social media? Is that what you said? Or you mean to expand into other avenues like public service announcements?
Other avenues like press announcements or things like that might get into the newspapers or onto the radio.
Yeah. And, I guess I sort of disagree with the fine line you're talking about, to the extent you think people might start to get inured to warnings. I mean, I grew up in the Midwest, and when there were tornado warnings, nobody really thought, oh, it's just another tornado warning. I mean, they took it seriously. And I think with weather predictions so good these days compared to how they used to be, if you start hearing about double-digit temperatures, negative double-digit temperatures, I think that falls into a category where people should be warned as a lot, or at least asked to start reducing their usage just to help manage the ability of the company to perform. But that's not to say you didn't do very well this time, but I'm just looking to see that continues and that customers know that you're thinking about them and at least want them to do their part that they can to minimize costs.
Yeah.
So, and I guess I have to say, the prices were absolutely extraordinary, but I don't think it was a surprise that they got a lot higher. I have seen instances where, there have been situations of, congestion and so forth, leading to reduced service in areas in wholesale markets. And, a price spike of like an order or two of magnitude for a short period of time is something that I think most participants in the gas trading world are aware of. So I don't think that should, I know the magnitude this time of the prices was even another order of magnitude or more than what we ordinarily see in cases like that. But I think that, we should be alert to the fact that there are going to be opportunities for this to be this severe in the future. And so I hope your thinking on how to proceed in the upcoming winters has been altered by this event. Can you speak to that at all?
Yeah, thanks, Commissioner Hall. You're right. There are isolated cases where prices have gone up. I don't know that they were quite as drastic as what we saw here and as prolonged as what they were here. That was probably the biggest issue here. Most our contracts, and Josh Tilbury can talk at length about this, but we have contracts set up that generally insulate us from these little short-term blips because our gas is, has fixed cost gas, or we have index-based gas, meaning it's based on an index price. What happened here was the prices were high and unbelievably high for so long that it started affecting the index pricing, which was really unheard of, especially to the levels we saw here. So that's really what happened. And so Josh can talk a lot more about that. So I think it was really quite extraordinary. In terms of what we're evaluating as we move forward and trying to look at this event and learn from it. And Josh can talk about this as well, but we're looking at our gas contracts themselves to determine if there are better options for procuring gas. Should we have more base gas that we procure versus swing gas, things like that. And so we're looking at those types of things. We're looking at our hedging program. We I don't know if commissioners know this or not, but we hedge all of our base gas because we can do that relatively inexpensively. We've never hedged swing gas because it's extraordinarily expensive, or it has been in the past. And my guess is following this event, it'll even be more expensive. But nonetheless, we want to look at our hedging program and make sure that we have the best possible program in place. We're also looking at the Kinder Morgan storage facility. Our lawyers are talking to their lawyers, and they are they're working on the contractual terms and the force majeure, and we're looking at other storage options. So we have a whole host of things we're looking at. I mentioned earlier the LNG. So yeah, in light of this, we have quite a few people in the organization looking at quite a few different aspects of how we operate to see if there's a way we can minimize this going forward. But so anyway, I don't want to prejudge that work, and but anyway, that work is ongoing, and we're going to do everything we can to prevent these types of things from happening again.
Wonderful. Okay, well, thank you very much. I appreciate your answers and your time. Mr. Hearing Examiner, that's all I have.
Okay, thank you. Commissioner Byrd, did you have any questions?
I do not. Thank you.
Okay. Do the commissioners who have asked questions previously have any further follow-ups? Okay, Mike Smith, did you have any questions?
No, I think I'm clear on Mr. Shell's testimony.
Okay, Mr. Shell, I have one or two questions for you, just to get clear about your short-term borrowing. Is the repayment schedule that you have for that, is that solely interest, or does it include interest and principal?
Thank you, Presiding Officer Schanauer. The repayment terms are quite flexible, and that was one of the things we liked about this interim financing was that we pay interest obviously on a periodic basis. I'm not sure. I imagine that's monthly. I don't know with certainty, but that's normally how these things are set up. That interest is paid monthly, but we can pay principal at any time, and there's no prepayment penalty or anything around that. So this term loan is very flexible in terms of how we move forward. If we decide that we want to refinance it in a few months, we have the flexibility to do that, and there's no prepayment penalties or anything like that. If we want to keep it outstanding the whole time and pay it all at the end, we can do that too. So it's quite flexible.
So if you were going to pay it all at the end, would and if you paid interest, solely interest throughout the 18 months of the loan, and you ended up owing $100 million in September of 2022, would that amount be large enough to issue a long-term debt issuance just for that particular amount?
Yes, it would. I think you're alluding to the fact that scale is a big deal when you're trying to issue private placements, and we issue generally in our long-term debt is privately placed, usually with insurance companies. They like to see larger amounts. 100 million would easily get refinanced in the private placement market.
What about 50 million?
You could do, I think 50 million is doable as well. The smaller you get, the little harder it gets, but it's doable at 50. I wouldn't want to get much below 50 million, I don't think.
But if you were to pay some amount of principal during the 18 months of the loan, and resulting in about 50 million owed at the end, your choice would be what then? How would you refinance that?
Well, I guess if in fact that's the route we went down to keep this interim financing outstanding for 18 months. So that's the first assumption. When we got to that point, I guess we would evaluate the market at that time and decide whether it made sense to refinance with a similar instrument or something that's more long-term in nature. And again, that would depend on, we evaluate all the time kind of our long-term financing needs, and that would just become part of our evaluation of what makes the most sense for our customers.
So if that were to be the case, the long-term financing that you would do at that point in time would also seek financing for other needs as well to package in a single issuance?
Yeah, I guess we kind of view our long-term financing, and I kind of view this as a long-term financing, even though it's only 18 months. We kind of view it as a bucket. So once it's in place, it is generally, and even the folks lending to you, they don't care what happened in the past. They just look at your current assets and your current long-term financing needs, and it's not necessarily tied specific to any particular thing. So does that answer your question?
Well, I'm thinking more about your perspective. How would you view it? Would you be packaging it in a bundle that includes refinancing requirements for this particular loan plus any other financing requirements that the company might have?
Yeah, so now that we have this loan, I kind of view it in totality with all our debt. So I would work with our VP of Finance and make sure that we're doing the best thing from a long-term perspective for our customers. And And that would be based on an evaluation of the market and where we expect the market to go. When I say where the market goes, interest rates. So it might be in our best interest to take 50 million or 75 million and issue it as long-term debt over 10 or 15 years if we have a need in our bucket of long-term financing for something like that. So yeah, it really, once the debt is in place, it kind of loses its what it's related to, and you just start making decisions that are based on the long-term best interest of customers.
Okay. All right. Thank you. That's all I had. Mr. Dome, did you have any redirect?
No, Mr. Hearing Examiner, I do not.
Okay, great. Then, Mr. Lee, are you okay continuing?
I would appreciate a break.
Okay. How about 10 minutes?
Yes, sir.
Okay, let's return in 10 minutes at, let's say, around 20 till 12.
Thank you, Mr. Lee.
Thank you.
Everybody.
Good morning, Mr. Shanauer. It's good to see you again.
Yeah, good morning, David. It's good to see you. Oh, looks like I see all the commissioners. Commissioner Vicente Aguilar, are you still on the phone?
Yes, I'm on. Thank you.
Okay, good. All right, well, let's go back on the record. Mr. Dome, do you want to call your next witness? You have to unmute yourself.
It's much better if I do that, isn't it? It's hard to read lips at this age, or any age. Yes, Mr. Hearing Examiner, we would call NMGC witness Josh Tilbury.
Mr. Lee, would you swear in Mr. Tilbury?
Mr. Tilbury, would you raise your right hand, please? You solemnly swear the testimony you're about to give in the matter now pending to be the truth, the whole truth, and nothing but the truth?
I do.
Thank you.
Mr. Tilbury, go ahead and state your name for the record, please, and spell it, please.
Josh Tilbury, JOSHTILBURY.
And what is your position with New Mexico Gas Company?
I am the Director of Gas Management.
Mr. Tilbury, you have in front of you, I hope, NMGC exhibit number 7. You recognize that document?
I do. It's
And
the
what
direct
is that?
testimony. It's my direct testimony.
Okay. Did you prepare that testimony, or was that testimony prepared at your direction and with your assistance?
It was.
Do you have any corrections to that testimony?
I do not.
If I was to ask you those questions that are in NMGC Exhibit 7 today, would your answers be the same?
They would be the same.
And this testimony was prepared by you and at your direction. Is that correct? I don't know.
It was.
Okay. Mr. Hearing Examiner, with that, I would move for the admission of Tilbury Exhibit number 7, NMGC Exhibit number 7.
Any objection?
Staff does not object.
Okay, NMGC exhibit number 7 is admitted.
With that, I would tender the witness for cross-examination, Mr. Hearing Examiner.
Okay, Mr. Borman?
I don't have any questions for Mr. Tilbury.
Okay, commissioners? Commissioner Maestas, did you have any questions? I think you indicated you did.
I did. Thank you. I had a mouthful. Good afternoon, Mr. Tilbury. In your chronology, which I really appreciated, it was a great narrative and kind of explained how the company took actions as the cold weather event unfolded. But of all the suppliers that you worked with during that cold weather event, there seemed to be a focus on Kinder Morgan, and specifically the storage agreement that New Mexico Gas Company has with Kinder Morgan. And I was trying to reconcile, I was trying to do the math to determine, okay, how much, so this is my question, how much did the gas company need to acquire and make up for what it couldn't acquire through the storage agreement with Kinder Morgan? So kind of like, how much was Kinder Morgan responsible for the total purchase on the open market?
Thank you, Commissioner Maestas. We look at that in 2 different parts. We looked at how much gas we requested from our storage facility to be withdrawn out of the ground to our systems. and I look at how much of that gas actually was pulled out of the ground and delivered to our customers. And then I also look at what happened because of the force majeure, and also with the mechanical failure and the low pressure for the storage facility, and what our withdrawal rights were reduced to, meaning we weren't entitled to our full withdrawal rights during this storm. So when you look at just how much gas we asked for versus how much gas showed up, it cost about $12.5 million to replace that gas out in the market. When you look at what I was entitled to versus what we were able to withdraw, meaning the reduction in our withdrawal rights, that was about $15 million. So overall, when you look at storage, it was about $27 million. Now, I will say on the other side of that coin, we were able to get about 490,000 MMBTUs out of storage during that period. And that offset about $55 million from being in the market by being able to pull that gas out of the ground and not have to participate in that extreme pricing event that we saw back in February.
So you, based on, I think your Exhibit 5, and there's no need to specifically, this is a quote, I'll mention this. Kinder Morgan claims that New Mexico Gas Company's gas reserves were not fully accessible during the weather event due to mechanical issues and low pressures at the storage facility, and that the claimed mechanical failure and low pressures meet the definition of force majeure under the operating statement. And you're evaluating these claims. What is the status of this evaluation? And, can the New Mexico Gas Company get a clarification, or can they assure New Mexico Gas Company that the invocation of force majeure was consistent with the agreement that you have with Kinder Morgan?
Thank you, Commissioner Maestas. I focus
me
on
just a
gas
minute.
and getting gas to the.
Excuse me, I'm sorry to interrupt. What exhibit are you referring to, Commissioner Maestas?
It's Exhibit 5.
To the application, Exhibit 5 to the application?
Yep, yes, I believe so.
The weighted average cost of gas?
It's page 17. Nicole Strausser's response to question F4.
Well, that's all right. I'll just listen to the answer. I'm not.
Mr. Tilbury,
you're referring to Exhibit 5, the responses that the company made to the commission's questions, correct? Yes.
Thank you very much.
So basically, Mr. Tilbury, I mean, it seems that New Mexico Gas Company hasn't accepted the response from Kinder Morgan at face value that they invoked force majeure because of, mechanical failure and low pressures. So what would satisfy New Mexico Gas Company that in fact Kinder Morgan legally and properly invoked force majeure in your agreement with Kinder Morgan?
Mr. Hearing Examiner, I need to interpose a soft objection at this point in time because this is a legal issue, and the counsel for New Mexico Gas Company is engaged with the counsel for Kinder Morgan, and the question asked Mr. Tilbury arguably for discussions that he's had with counsel as to what is the company's position with regard to Kinder Morgan, and I would instruct the witness just to not venture into attorney-client communications, because this is a matter that is open to negotiations and discussions right now between counsel for the gas company and Kinder Morgan.
Well, I think the witness can answer about what the company's position is, right?
If he can do that without getting into attorney-client communication, yes, Mr. Examiner, I agree.
Okay, well, that's the ruling. Go ahead, can you please go ahead and answer Commissioner Maestas' question, Mr. Tilbury?
Can you please repeat I'm sorry, can you please repeat that question so that way I can make sure that I answer it appropriately?
Sure. The invocation of force majeure by Kinder Morgan per the operating statement doesn't seem to be acceptable to the New Mexico Gas Company. And so my question is, what would be an acceptable explanation or confirmation that the invocation of force majeure was legal and proper per the storage agreement?
Thank you, Commissioner Maestas. And I guess I would start with, I'm focused on reliability and getting gas to the system. And during the storm, that's my total focus and my team's focus, to make sure that we continue to provide reliable gas service to our customers. Once we start to receive force majeure notices and other such documents, we react and continue to react and provide gas to our customers. My job with those type of things is to forward them on to my legal department for them to pursue with Kinder Morgan. And I remove myself pretty much from that, other than providing information to legal counsel as to what happened in the event, but really focus on the gas supply side. So I don't really know that I would go into great detail about all of the different things that would be acceptable in this instance.
Okay, my follow-up is the operating statement requires that during an event of force majeure, Kinder Morgan allocates available capacity on a pro rata basis among customers with firm service rights. Is this also a pending inquiry that the New Mexico Gas Company has with Kinder Morgan to assure New Mexico Gas Company that they did allocate pro rata among all their other clients?
I believe, my same answer would be to go back to legal counsel and say that, since I'm not an attorney, I would go back to my legal counsel for them to go in and look. I know that we, during the storm, we did have reduced withdrawal rights. I did not question those at the time. I just took what I could possibly get out of the storage facility with the limited information that I had at the time, and revised our plan to adapt to that, to make sure that we could provide enough gas.
Sure. I'm just trying to get a sense for, what the status is of these pending inquiries with Kinder Morgan, because to a certain extent, having to purchase the excessive costs on the open market was because of the invocation of force majeure. But in the chronology, it seems that other suppliers, besides Kinder Morgan, cut back supply. And I'm wondering, is the New Mexico Gas Company pursuing similar inquiries with your other suppliers besides Kinder Morgan for cutting back supplies during the cold weather event?
Yeah, so we did experience other supply disruptions out of the Permian Basin. One of our strategies whenever we see cold weather start to come into New Mexico is start to shift purchases away from the Permian and start to rely heavily on storage and shift purchases to the San Juan and maybe further north up to the Piceance basins. We did experience some cuts in the Permian from gas that we purchased. All of those contracts are prearranged, though. We go out to RFP or request for proposal in the spring prior to the winter. We put all of our swing gas, all of the gas that's the difference between our base gas that shows up every day and our actual demand. We contract that for that well in advance of the winter. And those contracts all have a predetermined volume that you can call on with the counterparty. It's a set price on all of our swing gas contracts. All that price is referencing an index price, a gas daily index price that's published by Platts, and it's the average price. So we're not beating the market. We're not paying more than the market or below the market. We're paying the market rate for that gas. And so when we call on that gas, we call on it per that contract. Now, if some of that gas doesn't show up, we only pay for what we receive. We don't pay for the full volume that we requested. It's an interesting situation as a gas buyer. Contractually, we're obligated to pay that price via the contract. And so that's the price we ended up paying.
Thank you. In the chronology, it seemed that the New Mexico Gas Company had an excess. I guess, just to quote the chronology, I think it was on the Thursday, February 18th. Throughout the day, more and more supply came back. We ended up having to reduce our withdrawal from storage several times because we had excess gas. So in the early cycles of the day, we had a few cuts, but we did not have to replace because we had so much excess gas. So how can the New Mexico Gas Company show that it did not over-acquire gas during the cold weather event?
Right. So I think a couple of things there. Typically, when you see storms, thank you, sorry, Commissioner Maestas, thank you for your question. I think a couple of things on that. Typically with storms like this, when they come in, they're very cold, especially when we see one come in from Texas area. We've seen that before. And we saw that wells were freezing up as that storm moved through Texas, Oklahoma, and into New Mexico. And so we anticipated supply disruptions coming in. And part of our strategy is to oversupply the system out of storage, to be able to anticipate those supply disruptions. So that way we're not in the market intraday where gas is typically the most expensive. We try to stay out of that as much as we can. So by being proactive, anticipating cuts, we can stay out of the intraday market. Now, what is also typical with these storms is once they come in, wells start freezing off. But as the temperatures start to warm up and that storm starts to dissipate a little bit, those wells start to come back on. We can't predict when that happens, but it will happen where gas starts to come back online, right? And so when that gas starts to come back online and those supply cuts that we were seeing previously throughout the previous days starts to come back online, well, then we have to respond. And the easiest way to do that is to reduce the amount of gas you have coming out of storage. Because of the fact that gas has already been purchased, it's in the ground, it hasn't come out of the ground, and I'm not contractually obligated to do anything with that like I am with my purchases. So during that Thursday that you're referencing, yes, we started to see some of our supply cuts return and some of the purchases that we were buying return. And so then we had to take some action because we were starting to get too much gas, and so we had to back off of our withdrawal a little bit.
Okay, thank you. Obviously, for a company like the New Mexico Gas Company, you have a variety of sources of gas, but particularly when it comes to storage, I think it is better to have company-controlled storage resources, correct? And I think that, in Exhibit 5 for today's hearing, in the gas company's response to the initial order, there was a statement that the New Mexico Gas Company is going to complete an evaluation of its controlled gas resources. And I think the implication is to try and reduce dependence on sources like from Kinder Morgan. Can you just describe maybe the extent of this evaluation and when you think you might have the evaluation completed, and in what form might it come back to the commission? Would you file a gas supply plan amendment? How can we be assured that New Mexico Gas Company is actively seeking to expand its controlled storage resources?
Thank you, Commissioner Maestas. I think I can speak to part of your question. I apologize because I can speak to part of it, but I'm not an expert on the back half of that question on the procedure of going through that, and would have to rely on somebody else to do that. But as far as on-system storage, you're correct. When we look at the Kinder Morgan storage, we're relying on someone else to own and operate that storage facility, and we lease it. So there's a potential point of failure. Then we have to move that gas on interstate pipelines to our systems because that storage system isn't directly connected. So then we're reliant on interstate pipelines to be able to move that gas. We're also reliant on interstate transportation, taking out transportation on the interstate pipelines to move it, which may or may not be available. And so there's another point. So when you take those 2 points out and you put a storage facility such as LNG on our system, then we own, operate, and it feeds directly into our system, removing 2 points of potential failure. And so, yes, I do believe we're looking at all options when it comes to storage. We realize that storage is an integral part of our supply strategy and how we supply the system. We all obviously live in New Mexico. We realize that sometimes you can get 3 or 4 seasons even in one single day, and it makes it challenging as a gas utility to be able to balance that. And we certainly I can appreciate and know that storage is a huge part of that. The ability to go into storage when you have too much gas, when the weather doesn't come in. You know, a typical day in December, January, or February, 1 degree is about 8,000 MMBTUs plus or minus. And so not only we're battling weather and forecasts, we are battling all the other different things that happen with supply. And so having on-system storage and having storage is a key part of our strategy going forward. I apologize on the second part of your question, the process about going for filing storage and everything else and notice to the commission and those things, that would be out of my normal realm that I would handle. I would come up with a strategy on how to use storage, how we'd implement storage, how we would fill it, how we would drain it and optimize it, those type of things. But the actual building of the storage facility and all the filings that go with that, that would be somebody else, whether that be. And so I'll stop there because I just don't know enough information to be able to provide you an answer on that.
So it seems, I guess you're implying that maybe this evaluation of your controlled gas storage resources is ongoing, but I'm trying to get to, is there a defined scope of this evaluation? When might this evaluation be concluded? And will there be any recommendations, for example, to maybe construct a new LNG storage facility, which I think in the past was deemed not cost effective? So I'm trying to get a sense for how committed is New Mexico Gas Company to expanding its controlled storage resources?
Thank you, Commissioner Maestas. I appreciate that. And we are looking at it very hard right now. And we're trying to make a decision on LNG and what is in the best interest of our customers at the most reasonable price. And so we're continuing to look at that. I know we're going out to look and see if we can start to get pricing and other things that are associated with that. So I'd say we're in the beginning stage of that.
So would you be amenable to, at least informing the commission of how that's going? Because I think lessons learned are great, but I really think that evaluation of company-controlled gas storage and the potential to expand them, I think, is a good one. And so I would like to know or be informed of any developments in that evaluation.
Yes, I think that would be fine. Thank you.
Okay. Thank you, Mr. Tilbury. Mr. Presiding Officer, that's all I had. Thank you.
Okay, thank you.
Mr. Hearing Examiner or Presiding Officer, could I follow up with a few questions there?
Of course, so go ahead, Commissioner Hall.
Okay, hi, Mr. Tilbury. I maybe didn't hear everything in your answer, but I heard you say in response to the last question, you're going to be looking very closely at LNG and the prices and so forth. Are you, as a company, looking at locating your own storage areas, say closer to the load centers? I read that somewhere, but I can't remember where I read that. I don't know if that was in some testimony. So I apologize if I'm asking a question that's not part of your testimony, but you seem like the guy to talk about. I don't know if that was in your testimony, but is that something the company is going to be doing?
Thank you, Commissioner Hall. Yes, that is something that we're looking at, locating a potential LNG storage facility right next to our load center, off of our, what I would refer to outside of Albuquerque area, off our northwest system. We are looking at that. That is correct.
So, I mean, if the weather were extreme enough, I suppose you would still have a vulnerability of having pipes freeze just for purposes of getting it out of your own storage facility. Is that right? And what can you say about that?
Well, I think thank you, Commissioner Hall. I think there's potential for anything, but what I would say is we own and operate our pipelines like a utility will, with the most reliable that we can. And we take great pride in that. And I think that's something that we would continue to do with an LNG facility, to make sure that it's up and available when we need it.
Okay. Thank you. That's all I had.
Thank you.
Any other questions from commissioners?
Yes.
Commissioner Fishman?
Yes, Mr. Presiding Officer. Mr. Tilbury, really just one question. You talked about the savings that storage provided in this event, in this pricing event. And I just wanted to ask, well, three numbers. What's NM Gas's total storage capacity? How much was in storage at the beginning of the event? How much was in storage at the end of the event?
Thank you, Chairman Fishman. We currently lease, at the time of the at the time of the winter event, we currently lease 3.2 BCF of storage capacity. I can get you what our exact inventory level was. I don't have that right in front of me at the time. And I apologize. What was the third part of that question?
So what was in storage at the beginning of the event, and what was in storage at the end of the event? So how much did you draw down storage?
Yeah, we withdrew during the time just under 500,000 MMBTUs during the winter storm. And so I know that number for you. We were able to withdraw about just 490,000 MMBTUs during that winter event period for the customers.
And that was out of a storage capacity of 3.2 million?
It was.
Okay.
Yes, it was. And we are limited on how much gas we can get out of the ground on a daily basis, depending on our inventory level. The fuller the facility is, the more gas we can get out. The smaller the facility, or the lower the inventory in the facility, the less gas we can get out.
Mm-hmm.
We were also hindered, obviously, by Kinder Morgan's force majeure that they had on how much gas we could get.
Right.
Excuse me, Mr. Fishman, could I just ask him to repeat that answer about this?
Yeah.
The smaller the amount, the harder it is to get out. Is that what you said?
Yes, ma'am. So the way the storage facility works, the fuller the storage facility, the more gas you can withdraw. And so our withdrawal rights are set up that way, the more gas we can get out. And so if we have large inventories in the ground, we can withdraw more. And as we start to go down in inventory, we actually can't withdraw as much as we could if it's full. And the opposite isn't true, with your injection rates. And so, sorry if I was confusing on that.
No, it's my misunderstanding. Thank you.
Thank you.
As part of this whole picture, one of the things I guess you guys will be looking at going forward is, I mean, obviously it would have been nice if you could have drawn it down further, whatever the technical and other limitations were. right? Could have saved consumers more money. And I'm presuming all that's going into your planning going forward on how you might improve that storage capability.
Thank you, Chairman Fisherman. That is correct. We're going to continue to analyze storage and how we operate it and the reliance on it. And just to let you know, I was able to get the number for you for part two of that
jealous.
question.
You got this staff right there at your fingertips. Let's hear.
Well, I am very lucky to have great staff, and that's part of that's yes, most definitely. We started the winter storm at 1.3 BCF of gas in the ground, and we ended it at just under 900,000 MMBTUs in the ground. Part of the reason we are down in inventory is we just came through December and January, and we tried to pull out some of that gas for our customers during that period of time as well. Our gas in the ground was considerably less expensive than the market, so we want to give that benefit to our customers throughout the winter months. And then also part of our strategy is starting in February is to start to pull out the gas out of the ground. And I think our gas was roughly in the ground about half the cost of just the average price in February before the storm. It was considerably less expensive during the storm, but just trying to spread that benefit out and help our customers throughout. So we're sitting at just under 1.4 BCF going into the storm.
Okay, so you were under half your total capacity at that point.
Correct.
In terms of actually stored. Okay, well, thank you.
Thank you.
Commissioner Hall, did you have any more questions?
You're on mute, Commissioner Hall.
Yes, I do. Just a few. And it's just to follow up on this storage concept a little more. So I understand, Mr. Tilbury, that the gas that you have stored in the ground, you've purchased at a time when the price is lower. So that's what you were drawing out first to use for customers to begin with until there was a problem in being able to get it out of the ground, correct?
Thank you, Commissioner Hall. When you look at how much the demand was for the system, storage alone was never going to be able to fill the gap between what demand was and what we actually needed to supply the system. You know, I only had access if storage was working at 100% with our inventory levels. I was able to withdraw 165,000 MMBTUs without a force majeure in effect. Even if I would have gotten all of that gas out of storage, I still would have had to been in the market buying gas.
Oh, correct.
To cover the difference between actual demand. So what we did is we tried to withdraw as much gas out of the ground as we possibly could because we realized that was the cheapest. And then we go into the market and fill up the difference between actual demand and what was left. So
okay, so
I'm not sure if that answered your question, but that's how we look at it. Yes, ma'am.
I got a follow-up for you. So when you say as much as you possibly could, that means as much as you could possibly fill your own pipes, or was there some impairment in the ability to get the gas out of your storage facility that limited what you drew out or limited what you were able to provide to customers?
Thank you, Commissioner Hall. Yes, on Sunday, I believe that was Valentine's Day, Kinder Morgan storage facility declared a force majeure due to mechanical failure and low inventory pressure. That hindered the amount of gas that we could get out of the ground by about half, depending on the day.
Okay, great. So my question is, and it's a little bit more general, but going forward, is there a certain time of year when you find gas more inexpensive, or do you just have to keep watching the market the whole time? How do you replenish what you need to replenish?
Thank you, Commissioner Hall. That's something we do on an annual basis, and we put together a storage plan. And part of that storage plan is when we go back in to fill up or replenish the gas in the ground. And as far as less expensive pricing, yes, there's typically 2 seasons when that happens, and we typically call them the shoulder months in my world, but the shoulder months would be spring and fall. When you come out of winter, you don't have a lot of power demand yet, and you don't have a lot of heating. So typically the market comes down, and we look to put gas in the ground then. And then all of a sudden during the summertime, we do put a little bit of gas in the ground through the summertime, but you're also competing with power loads and stuff and power demand on gas for natural gas fire generation. And so we put a little bit in there, and then come September, August, we tend to look at putting more gas in because power loads dropped off. We haven't really started to get into heating season, which typically in New Mexico is going to be your November, December, January. So we start to put more gas in the ground. That's typically how we do it. There are obviously different things that happened over the last several years. When we saw negative pricing in the Permian, we were trying to put as much of that gas as we possibly could in the ground when that phenomenon was happening, because it was free gas we were getting paid to take to put in for the benefit of the customer. So those are the things that we were trying to do. So we adjust our plan as we can.
Okay. And I don't know anything about the possibility of getting your own storage facilities. Are facilities, they're holes in the ground, right? Where something's been pulled out, or what are they?
Thank you, Commissioner Hall. The one that we were talking about earlier is an above ground LNG facility. I believe there's other utilities. They also have above ground LNG facilities.
Oh, I see.
It would be liquefied gas that we would liquefy, put into a storage tank for us to be able to pull out when we need it.
I see. Thank you, Mr.
But you are
Henry.
correct. I'm sorry.
Oh, go
I was
ahead.
just going to say, you are correct. There are several different types of storage facilities. And yes, some of them are depleted reservoirs. Some of them are salt domes. Some of them are salt caverns. Some of them are aquifer storage facilities. But the one that we were talking about in particular was an above ground LNG facility. So you're correct in part of your statement as well.
So are the above ground ones then more vulnerable to the cold weather?
I'm not an engineer, so I would be hesitant to answer that. But my understanding from everything that I know about them is that they're a very reliable source of gas coming onto the system.
Okay. Thank you very much. Thank you, Mr. Presiding Officer.
Okay, any other questions? Commissioner Vicente Aguilar? Do you have no questions? We can go on to Commissioner Byrd. Commissioner Byrd?
I do not. Thank you.
Okay. Mike Smith, do you have anything?
None, thanks.
Okay. I also have no questions. Mr. Dome, do you have any redirect?
No, I do not, Mr. Hearing Examiner. I do not.
Okay. Thank you, Mr. Tilbury. You're excused. Your next witness.
Mr. Hearing Examiner, Commissioners, we would
Oh,
call Dan Yardley, and this is Brian Haverly speaking for the court reporter. We call Dan Yardley to the stand.
Okay. Mr. Lee, could you swear him in?
Mr. Yardley, would you raise your right hand, please?
Yes.
Mr. Yardley, you solemnly swear the testimony you're about to give in the matter not pending should be the truth, the whole truth, nothing but the truth?
Yes, I do.
Thank you very much.
And Mr. Hearing Examiner, as just a preliminary note, because Mr. Yardley is the witness here that is dealing with all of the rate design for the recovery, he has lots of changes in his testimony and specifically his exhibits because of the $2.6 million that we recovered in EGS gas. Instead of going through line by line all these changes, I was going to suggest as a more efficient mode for the commission that I just have Mr. Yardley acknowledge the corrected version of his testimony, which we have provided to the commissioners and to the hearing examiner and to staff, and say that as corrected with the corrections, that that's a true and accurate copy of his testimony. Is that acceptable in the idea of efficiencies?
Well, does that have the correction that Mr. Dome mentioned earlier today?
So that would be in Exhibit 6, and I'm sorry, yes, in Exhibit 6, and he can do that separately. That's not part of his testimony, Mr. Hearing Examiner, and I was going to walk him through Exhibit 6 separately.
Okay. Mr. Borman, do you have any objection to that procedure?
I do not have an objection to it, no.
Do any commissioners have any issues with that procedure? Do you have the testimony, the corrected testimony that Mr. Haverly is referring to? It would be the testimony, I believe, that Isaac sent out yesterday.
I can't find that email. I would like Isaac to send it to me again because I've been searching for that and I can't find it. I would like to see that corrected testimony that apparently was sent out yesterday. This is
Isaac,
Commissioner Hall.
Just 1 moment, I'll resend it.
I'm sorry, Isaac.
Give me just 1 moment, I'll resend it.
Thank you.
And was that sent to Mr. Lee as well?
Yes, sir.
It was.
Okay, okay. All right, well, we can go through the preliminaries to get that exhibit admitted. And by the time we get to questions, hopefully that will have been received. Commissioner Hall, have you received it yet? Can you see your email?
I'm looking here. Maybe this is it. Corrected. Yes, that looks like that's. I got it.
Okay.
Thank you very much.
All right. Well, go ahead then, Mr. Haverly, on that basis.
Thank you, Mr. Hearing Examiner. Mr. Yardley, would you please state your full name for the record?
My name is Daniel P. Yardley.
Mr. Yardley, who are you employed by and what is your position?
I'm an independent consultant providing rate and regulatory advisory services to natural gas utilities.
Mr. Yardley, you have before you what has been marked as NMGC exhibit number 8. Do you recognize this exhibit?
Yes.
What is it?
It's my direct testimony and exhibits filed April 16th, 2021.
Mr. Yardley, was exhibit 8 prepared by you or at your direction?
Yes.
And Mr. Yardley, have you made any corrections or changes to your testimony since it was filed?
Yes, I have.
Okay. Mr. Yardley, why did those corrections and changes occur?
All the changes to my testimony are a direct result of the $2.6 million payment received from the EGS customer that reduced the amount of the gas costs the company is seeking to recover in this proceeding.
And Mr. Yardley, with the corrections that have been noted in the exhibit 8 that has been provided to the commission and the court reporter, is your testimony true and correct?
Yes.
And if I asked you those questions today, would you give me the same answers as they appear in your testimony in exhibit 8 as corrected?
Yes.
And with the exhibits that have been replaced in your testimony, are those now true and correct?
Yes, they are.
Mr. Hearing Examiner, I move to introduce NMGC exhibit number 8 as corrected.
Is there any objection?
Staff does not object.
Okay, NMGC exhibit 8 is admitted as corrected.
Thank you. And Mr. Yardley, could you please turn to what has previously been marked as NMGC exhibit number 6, which is the New Mexico Gas Company Inc. response to Venture Quest?
I have that.
On page 3, table 2, there were some prior corrections that were discussed by Mr. Shell and Mr. Domi. Can you please walk us through those changes to the table? Well, actually, first, let me ask you this. Was this table prepared by you or at your direction?
Yes, it was.
Okay. And can you please walk us through any corrections that are necessary for table 2?
Yes, on page 3, under the section rate 30 irrigation, the bottom row of that section has 3 numbers that need to be corrected. So the label is average monthly percentage impact. For the next column under the 30-month recovery, the correct percentage is 4.7. And then under the column for the 36-month recovery, the correct percentage is 3.9. And under the column for the 48-month recovery, the correct percentage is 3.0.
Thank you, Mr. Yardley. Are there any other changes that need to be made to exhibit number 6 in any of the tables that are?
I'm sorry to interrupt. Can I get those numbers again, please?
Certainly. So again, we're on the row titled average monthly percentage impact rate 30 irrigation. It's about halfway down the page. The 30-month recovery should be 4.7%, and that's instead of 2.6. 2.6 is incorrect.
So what page are we on?
Oh, it's page 3 of the document, table 2.
Okay. And oh, I see where we are. What's the percentage there now then?
Okay, so yeah, so for
irrigation.
the third,
oh,
yeah,
this,
irrigation, 30-month,
Uh-huh.
the correct percentage is 4.7.
I have it. I have it. I've got the corrected version. Okay, thank you. Thanks very much.
Thank you, Commissioner. Mr. Yardley, are there any additional changes that need to be made to Exhibit 6 in any of the tables or any of the numbers?
Not that I'm aware of.
So as corrected, these tables and numbers are true and correct. Is that an accurate statement?
Yes.
So Mr. Hearing Examiner, I believe Exhibit 6 is already in the record. I think if there's anything else that the Commission would like to ask about that, we are happy to have Mr. Yardley discuss all of those numbers and tables.
Well, you're correct that Exhibit 6 has been admitted into the record. Do you have any further questions for Mr. Yardley?
I do not, Mr. Hearing Examiner. I tender him for examination.
Okay. Mr. Borman, do you have any questions?
Just one second. I'm looking at my list and yeah, I do have one question, I think, if I may.
Go ahead.
Mr. Yardley, are you familiar with how the carrying charge is applied in New Mexico Gas's PGAC?
I am not actually familiar with that tariff and how that works.
Okay, and then I don't have any other questions.
Commissioners, any questions? Well, I'll start at the top. Chairman Fishman, do you have any questions?
You're still muted, Mr. Fishman. I didn't hear him, Judge.
I didn't hear him at all. You're muted.
Now am I unmuted?
You're unmuted now.
Okay, thank you. Mr. Yardley, I wanted to ask specifically, in response to the bench request, you had submitted your own plan by class that was a little different than what was requested. And I just wanted to, wondered if you could briefly talk through what you think the advantages and disadvantages of one versus the other are, and give your comments on that.
Yes, I'd be happy to, and I think that would be helpful to the record. There are essentially 3 concepts for recovery, and conceptually, I'm comfortable with any of them. However, I had the benefit of running the rates and looking at the numbers, so I will give you some advantages and disadvantages, because you do need to go through that additional step, and that's part of the reason why we went from 2 to 3. So the first one is essentially just recovery on an annual basis. It's very consistent with the PGAC, and that was why we put that in as our initial proposal. And it's beneficial, I think, as I comment comment on this, to actually be looking at table 1, which is on page 2. It was helpful that you asked that initial question, because that gives a sense as to the percentages of the gas costs that go to each class under the different concepts. So the first concept is really the last column of numbers. What would the percentage be for each class if we just had done this, as I said, consistent with the PGAC? This is how we derived all the numbers that are in my exhibits. And what you'll see when you look at that is that New Mexico Gas Company is, for sales customers, largely a residential customer base, but there's also a lot of small commercial. It's pretty much almost 3/4 residential, 1/4 small commercial, but then there's a little bit of sales volumes in these other 4 classes: irrigation, NGV, medium commercial, and large commercial. So I'm comfortable with the rates. I'm comfortable with the approach of using what ends up being that allocation, which is then reflected in table 3 in this bench request. That said, after we made the initial filing, we were following the commissioner's discussions in other cases. And I think the commission did zero in on, quite honestly, an important issue, which related to the potential that perhaps there are customers that don't peak in the winter period, but maybe peak outside of the winter period. And for New Mexico Gas Company, they really have one of these 6 classes that peak outside of the winter period, and that's the irrigation customers. And that also was the class that was a focus of the ZI hearing. And I do think it's appropriate to look at, well, should we consider perhaps some different type of rate mechanism to treat the irrigation customers differently, because, or any other customers that maybe use less during the peak period, because they would end up paying more of the impacts when we do this on an annual basis, which was what we had initially proposed. So the bench request that did come in was helpful. And that said, well, look at allocating on a February basis. And so the company pulled together information for February cycles. We couldn't isolate just for these, 5 or 6 days, but February cycle is very representative in my view of what the usage was. And if you look at the percentages in the middle column of table 1 and you compare them to table 2, they're very similar, but you will see a fairly large difference for irrigation customers. Again, that makes sense that they only would be allocated 0.3% because they're not really using a lot in February. So in that sense, conceptually, in my view, the information presented in this table 1 for February started to make sense. However, there was a couple unintended consequences for New Mexico Gas Company in particular. And that's that when you do look at February rather than annual, you would expect most of the classes to be similar, except irrigation, again, knowing their customer base. But what happened was, as expected, residential picks up a little bit more of the allocation because they're the majority of the customer base. But when you look at rate 56 and 58 in particular, these are the very large customers on the New Mexico Gas system. What you'd want to have happen is they would only pick up a little bit more of the gas costs because you were reducing the irrigation. However, the actual numbers and the way they worked out, they picked up quite a bit. And that is not really a good outcome, in my opinion. It's not really consistent with what's happening. It's just what the data produced. And it's a concern in that these are the more price sensitive customers on the system. So
Excuse me, Mr. Herring, we're still talking on table 1, are we not?
yes, I'm still trying to answer the advantages and disadvantages.
So for example, for rate 56, the medium volume service going from 1.6% to 2%, you're calling a pretty big increase.
Yeah, it is, because it's 25% increase in what they're getting, or a 20%
Okay.
increase. So that's why I'm saying that. It's small on a
you.
percentage basis, but it will be a big bill impact when you translate this into rates.
Thank you very much.
Sure. So again, I thought this was a good concept, but in the interest of further developing the record and actually giving the commission something that is a good alternative to what the company filed that doesn't have these unintended consequences, we looked at a third alternative, which was to say, let's just take the irrigation customers, which are truly off-peak, separate those out, they get a smaller allocation, but keep all the other groups combined for allocation purposes. And so the rates and the impacts from that third alternative are presented in table 4. And again, conceptually, any of the 3 alternatives are fine, but if I were recommending the commission to look at what is appropriate and fair, I would say either what the company filed, which was on an annual basis, or if the commission has an interest in shielding some, higher impacts to off-peak customers, which in the case of New Mexico Gas Company is irrigation, then I would say, look at the rates in table 4.
Mr. Hearing Examiner, if I could just ask just a clarifying question. Mr. Yardley, every single scenario includes the 3.7% carrying charge.
That is
Right.
correct. Yes.
Okay, thank you.
Commissioner Fishman, did you have any further questions?
No, I'm just looking at the charts a little more carefully now, and I might want to come back as I'm looking at them, but feel free to push us to let other commissioners ask their questions.
Okay. When I said I was starting from the top, I'm starting from the top of the screen that I'm seeing here. Nothing else intended there. Going down on the screen, I see Commissioner Maestas. Did you have anything further?
Yes, yes, Mr. Hearing Officer. Mr. Yardley, I think you've mainly opined on the 3 primary concepts, but there's also some other variables, and that's the recovery period. Is there a certain recovery period that you think is perhaps fair? Having all this information now, looking at these different concepts of recovery, but I think I'd like to hear your opinion on the actual recovery periods. Obviously, the rate impact is less for 48 months, but given what the company has requested and what you have before you now, including the bench request or the information stemming from the bench request, do you have a preference or an opinion on an appropriate recovery period?
Yes, I do. And Commissioner Maestas, while we hadn't looked at the issue of off-peak versus, peak customers, we had discussed and I had consulted with the company on the length of the recovery period prior to filing. So I did weigh in, and I do think the 30-month recovery period is appropriate. But essentially, you are balancing a couple different objectives, and you've highlighted them. So it is, somewhat subjective in terms of the approach, but the shorter time period does contribute to larger bill impacts. But those bill impacts occur over a shorter time period. A longer time period reduces the bill impacts, but does, lead to some additional carrying charges and so forth. And you do run into the risk that you won't have paid this off when there might be some, other situations that you want to deal with. So you want to pay it off as soon as you can. And I do think in the case of the amount of money, the bill impacts, and looking at them, the 30-month comes out to be reasonable. But again, we actually had looked at some shorter time periods, and we had looked at the others that are requested in the bench request as well. So, but again, that's my opinion. I think you certainly have some information before you to make that decision as well.
Okay, Mr. Yardley, in rate setting in general, we talk about gradualism, and in particular in these recent PGAC cases, we've been talking about rate shock, and we can't seem to get our hands on a definition, but what's your sense of what constitutes rate shock as a percentage increase in average rate class bills? Like, for example, in this scenario, is it over 30%? Is that rate shock? Is it over 20%? Can you just maybe elaborate on what your opinion or your perspective or what your experience tells you what you think rate shock is?
Certainly, and I can appreciate you've probably been having difficulty getting at that because it is, again, a little bit subjective, but also it does need to take into account one very important fact, which is going to be different from one situation to another with the same company or one company to another. And that's, essentially, what the pot of dollars is that you're trying to deal with. Because as a practical matter, you do have to come up with some way of recovering, whatever the specific amount of money is. So in this case, we're dealing with, approximately $110 million. We want to consider, the time period and then the allocation to different customers. The time period, I think, if you, what I was able to look at for, again, under the company's proposal, the 30-month time period was about an average of $5.60 a month, which was about, 13%. It's not desirable to have to put that kind of an increase on customers if you don't have to. But that, in my mind, doesn't constitute, rate shock. I do think, if you were, in this case, if we're dealing with this quantity of money and we tried to do it over like a 4 or 5 month time frame, that would be rate shock. That would be, customers would really experience that, and that would lead to a lot of negative consequences. So 30 months isn't, 4 or 5 months is, where you draw the line in between. I think some people, might come to a different opinion about that.
And I ask that because we're dealing with the consequences of an incredible pandemic where many of your customers are facing large arrears. And so that's why I would think that you're considering the current circumstances with your customer base, particularly residential customers. So would that be true, Mr. Yardley, that your opinion on the favorable recovery period considers the current conditions of your customer base as a consequence of COVID-19 or the pandemic?
Yes, it does. However, I would add that it's also important to take into account any assistance programs, because I'm not familiar with what's available in New Mexico per se, but, typically you try to do the rate setting as best you can, and then just be aware that there are often some safety net, things in place that are needed for customers that are facing particular hardship, which might be because of COVID-19 or it might just be because of other things going on. You need to have that in place as well.
Well, Mr. Yardley, my last question is how the commission should interpret this information now knowing, excuse me, the current circumstances of the financing. I think looking at a 30-month recovery, we're assuming that the interest rate and all the financial terms are fixed over the 30-month period. But in previous testimony, we've heard that, the $100 million debt could be combined with overall long-term debt, and those circumstances can change. So how can we consider these in light of a very fluid financing scenario if the New Mexico Gas Company does in fact refinance the 100 million as a part of its combined long-term debt? How can we do that? How can we be accurate, but yet consider the possible changes in the financing?
Commissioner Mestis, that's a good question, and one that we can actually deal with through rate making, and that you'll have the ability to deal with in your order in this case, in my view. There are essentially, though, a couple aspects of your question. So the first one is, what is the basis for the interest rate that you want to apply to the 110 million? And the company has put forward a case that says it should be the long-term debt rate. From my perspective, that makes the calculation of the rate somewhat straightforward. I just have a number and it doesn't change. And I always like that. But to the extent that you want to take some kind of a different approach, it can be dealt with through rate making. And let me just, by way of example, indicate that you first would have to say, you'd have to make some determination about how you're establishing what the basis for the rate is going to be. And it's going to be something different than looking at the package of debt, as Mr. Shell was describing. It's a whole basket. It sounds like you would have to somehow identify a certain debt instrument or a debt instrument that might change, later, because again, Mr. Shell has already testified he's already looking at refinancing that. It may occur, it may not occur. So you'd have to make some determination in your order. But once you do that first step, from a rate making perspective, there are complicated ways of dealing with it, and there are pretty straightforward ways of dealing with it. So a complicated way would be changing the rates every month. I would strongly say let's not do that. But it's really not necessary to do that. We do have rate making tools that we can use to deal with the potential for a fluctuating interest rate or different instruments. And I think it might be helpful just to turn to one of my exhibits for me to be able to explain this. So if you would turn to
Are we talking a hearing exhibit?
So no, it's going to be part of Exhibit 8, hearing exhibit number 8. It's going to be then NMGC second revised exhibit DPY3, which is again part of exhibit number 8. So
okay, what page?
it's page 1 of 1. NMGC second revised exhibit 3.
I'm on exhibit 8 and I don't see that.
Well, exhibit 8 has should have 7
Exhibit
pages
8
of question and answers.
Testimony, right, Mr. Yard?
Yes, 7 pages of question and answers followed by some exhibits.
So that would be in the application.
That would be in his separately filed testimony. It's called the direct testimony of exhibits of Daniel Yardley, and it was admitted as Exhibit 8 today.
Could you repeat that, Ashley, what you just said?
It's his direct testimony and exhibits of Daniel Yardley. The date was April 16th, 2021. It was, the corrected version was filed with what Isaac sent you just a few moments ago. So Mr. Yardley's testimony that you just received from Isaac. That
well, what I got from Isaac was answer to bench request questions. So I'll go to the docket to get this thing that we're talking about. I think
Commissioner Hall, this wouldn't be in the docket yet. I believe we're looking at Exhibit 8, which was included with the final e-agenda, which I sent out yesterday, and then I forwarded it to you again at about 12:20. So if you open that email from 12:20
Yes.
and then go, it'll be the second to last attachment there.
See what I can find.
If you'd like to try to have the discussion without the exhibit, I can try to do that as well. I thought it would be easier,
Sure.
but perhaps it
Sure.
isn't. Okay, so we're talking about setting a rate and having a variable interest rate. And we do have, related to this recovery, some other things that are going to vary as well. Like the actual revenues are going to vary depending on whether it's warm or colder than normal. So the balance may start to pay down a little quicker or a little slower. And the interest carrying charges that are going to be applied to the balance are going to be recorded on a monthly basis as well. So if there's fluctuating interest, what we can do is set the rate and then just track in an amortization schedule what the actual revenues are that are coming in and what the actual carrying charges are on a monthly basis using whatever the interest rate is associated with the debt instrument that you've identified. If it's the existing debt instrument, then that interest rate would fluctuate monthly. If it's a replacement debt instrument, it would probably fluctuate monthly up until that point in time where there was a new debt instrument, and then I would imagine it might be fixed for the remainder of the 30 months. But in any case, what we'll have happen is we've projected what will happen to this balance over the 30 months. But what's actually going to happen is going to be, a little bit one way or the other from the projection. And there's two things that are going to happen.
Mr. Hearing Examiner, I'm sorry to interrupt, but if Ashley could just send me whatever document is being referred to. I know Mr. Yardley said he wasn't wanting to proceed without the document, but I would really much prefer to look at numbers he's talking about. If that.
Commissioner Hall, I just sent an email that the subject is NMGC Exhibit 8, Yardley corrected direct, and it just has one attachment. Which
Thank you, I appreciate it, because the other one had so many attachments I was having to search and get behind, so I appreciate that.
So have you been able to pull it up?
I have it, Exhibit 8. Okay, I was on Exhibit 8. Okay, hang on.
And Exhibit 8 has a number of attachments.
I know.
And Mr. Yardley, which one are you referring to?
That's where I got.
Yeah, and I was actually now trying to answer without referring to it, but the one that is relevant is NMGC Second Revised Exhibit DPY3. I don't know if that's the label of the electronic file you're looking at, but that's the paper copy that I'm looking at. NMGC Second Revised Exhibit DPY3.
And
DPY3.
What's the title on that page?
New Mexico Gas Company 2021 Winter Weather Event, Amortization of Gas Cost Recoveries.
I'm there.
I'm there. I got it. Okay.
20 of the PDF.
Now,
Thank you very much. I appreciate your patience.
I'd offer to start over, but I don't think you want me to do that
I
necessarily.
do, actually. Please do.
Okay, so here we have a schedule. It's a one-page schedule that is our projection of the amortization that we use to set rates. Now, the application, which was based on a 3.7% interest rate, actually recognized that the amortization might go a little differently than what's on this page. You see we have a beginning balance, and then every month we have revenues that are credited against the beginning balance. Those revenues are what we think is going to happen. But if it is warm weather, there'll be a little less revenue. If there's cold weather, there'll be a little bit more revenue. And then depending on the balance, there might be a little bit more carrying charges or a little bit less, again, on a monthly basis at the 3.7% interest rate. What the company proposed was two things to deal with the fact that the amortization might not go exactly as we think it's going to go as we're sitting here, right before it starts. The first of those things is in paragraph 31 of the application, which is on page 28 of the application. What that says is that
Page 28 of the application?
yes, and you can refer to it, but it's simple. So I'll let you know what the concept is. That concept is we have a 30-month recovery period. 15 months in.
Which paragraph is it, please?
Paragraph 31.
Well, oh, I see. Okay, fine. Thank you.
Yep.
Proceed.
So what this paragraph says is there's a 30-month amortization period. We'll take a look at it 15 months in. And if there's any, material deviation, then the company will let the commission know that we're a little off schedule.
One second.
Planned.
Are you only looking at paragraph 31 because?
Yeah. So it says
say quite that.
The company will revisit the status of the gas cost recovery under this plan and report to the commission in October 2022. October 2022 is 15 months into the planned recovery. It'll report the status of the recovery plan, including whether the full recovery is on schedule, and if not, any adjustments to the rate to get the recovery back on schedule. So that's an element of the company's initial proposal that could also accommodate not only revenue impacts being a little bit different than planned, but also interest rate changes. And that can be accommodated without having to necessarily change the rate every month, for instance. So it's a good mechanism to get back on track.
May I step in for just a second?
Please do.
Mr. Fishman, go ahead.
I'm sorry. It seems to me we could just do, and this is probably where you're headed, just a simple annual true-up mechanism. We're going to charge, 1% interest, and then at the end of the year, you'll take a look at what your total, bank charges were, and basically do a true-up factor for the rest of the year. Could it be as simple as that?
Yes, you could. And I would say what you would do, the true up, you would adjust the rate a little bit. That would be the true up. Yeah, right. Definitely. And, my view is keep it simple. So the company had proposed one true up in the middle. The other thing that's an element of their plan, which you will need, is there might be a small balance at the end. And the recommendation was take the balance and put it back in the PGAC, positive or negative. So there's really two things already built in as a way to deal with, what could be differences in interest or anything else to keep the plan on track without creating all kinds of rate complexity.
Right. So the conversation was getting kind of complicated there, and I just wanted to
I apologize for that.
No, it's okay. But basically the idea is have a fixed charge for each month, and then at the end of the year, take a look between the actual interest cost versus what was built into the rate, and then just make an adjustment to the rate for the next year going forward to even things out. And
Yes.
It's the same kind of mechanism we use all the time.
Sounds good.
Okay, we were having questions from Commissioner Maestas. Let's go back to him.
Yeah, that concludes my questions, Mr. Presiding Officer. Thank you.
Okay, Commissioner Hall, did you have anything further?
No, I don't. Thank you very much.
Okay, Commissioner Vicente Aguilar, do you have any questions?
No questions. Thank you.
Okay, thank you. Commissioner Byrd.
Always
I'm sorry, Judge, I didn't get that.
Yeah, I think your connection is.
No, I don't have any.
Oh, okay. All right. Mike Smith, do you have anything?
No, I don't.
Okay, I don't either. Mr. Haverly, did you have any redirect?
No, Mr. Presiding Officer, I do not have any redirect. Thank you.
Okay. If I'm right, that concludes the testimony from the gas company.
Yes, Mr. Hearing Examiner, that concludes our case.
Okay, let's move to staff. Mr. Borman, do you want to call your witness?
Thank you. At this time, I would call Gabriella Dashino.
Mr. Lee, will you swear her in?
Ms. Dashno, would you raise your right hand? You do solemnly swear the testimony you're about to give in the matter now pending shall be the truth, the whole truth, and nothing but the truth?
I do.
Thank you very much.
Good afternoon, Ms. Dashino.
Good afternoon.
By whom are you employed and in what capacity?
New Mexico Public Regulation Commission, the Accounting Bureau Chief for the Utility Division.
As part of your duties in that position, did you review the application by New Mexico Gas Company that is the subject of today's proceeding?
Yes, I did.
Based upon that review, did you prepare or participate in preparing testimony regarding that application?
Yes, I did.
You should have before you a document marked as Staff Exhibit 1. Can you identify that document?
Yes, it is my direct testimony filed May 18th, 2021.
Was Staff Exhibit 1 prepared by you or under your supervision?
Yes, it was.
Do you have any corrections to that testimony?
I do not.
Okay. If I asked you today the same questions as are set forth in Staff Exhibit 1, would your answers be the same?
Yes.
Okay, and those answers are true and correct to the best of your knowledge?
Yes, they are.
Okay. Do you adopt Staff Exhibit 1 as your direct testimony in this matter?
Yes.
Thank you. At this time, I would move admission of Staff Exhibit 1.
Any objection? Hearing no objection, Staff Exhibit 1 is admitted.
Thank you. Ms. Dashino is available for cross-examination.
Okay, I'm not sure which counsel is going to be. Mr. Dome, do you go ahead?
Thank you, Mr. Hearing Examiner. I have just a couple of questions. Ms. Dashino, could you turn to page 14 of your testimony, please? And I'm looking at lines 2, 3, and 4.
Yes, I am there.
And in that testimony, you say that your recommendation is that NMGC should not be granted a regulatory asset or be allowed to recover any interest and fees from its customers related to the extraordinary cost of the events. Do you see that testimony?
Yes.
Is that still your position, or are you, or have you modified that position at all with regard to the company's recovery of any interest in this case?
Based on the previous hearings that I've testified in and the commission decisions and what we've heard today, I would say my position would be that New Mexico Gas Company be allowed to collect interest based on the loan that they acquired to finance these extraordinary gas costs.
I take it that your recommendation would not be that the company gets to recover its carrying charge as we proposed.
That is correct.
But you would recommend that we be allowed to recover the actual interest of that loan. Is that correct?
Yes.
Dome, could you speak up? I'm having a little trouble. I believe.
I guess I get my computer's fine. Can you hear me now? Can you hear me better now?
Yes.
Should I repeat that, Mr. Hearing Examiner, or did you get it?
Please repeat it, yeah.
Okay, so I'm not sure what you didn't hear, but Ms. let me just do the whole thing over again. Ms. Deschanel, on page 14, your initial testimony said that the recommendation was that New Mexico Gas Company should not be allowed to recover any interest and fees from its customers related to the extraordinary cost of this event. And I think your testimony was that's no longer your recommendation. Could you repeat for the record what your recommendation is now with respect to interest and fees recovered by the company?
Yes, I would recommend that New Mexico Gas Company be allowed the interest on the loan that was acquired to finance the extraordinary gas costs.
Okay. That's all I have. Thank you very much, Mr. Hearing Examiner.
Any questions from commissioners? Commissioner
Mr.
Fishman?
Hearing Examiner? I'm sorry.
Go ahead, Commissioner Maestas.
Commissioner Maestas.
You're on mute.
Sorry. Ms. Deschanel, good afternoon. Have you had an opportunity to look at the response to Chairman Fishman's bench request asking for an analysis of the rates of each rate class based on usage, along with different recovery periods? I believe it was 30 month, 36 month, and 48 month. Have you looked at that information?
Yes, I have.
Can you just indicate, based on that and considering your idea of rate shock, for example, table 4, the corrected table 4, do you have a preference for a certain recovery period? Do you have a preference for the scenario where we allocate costs by usage, by rate class? Can you just state your preference of what you think would be balancing the interests of the New Mexico Gas Company and ratepayers?
Well, I think you had asked the question from Dan Yardley if those rates included the 3.7 carrying costs. And since they do include that, depending on what the commission decides, the 36-month seems like the best approach. However, if the commission decides to go with the 0.75% interest rate, well, I don't see an issue with the 30-month recovery period. And as far as usage by customer, and I'm not sure if you're referencing the irrigation rate that Dan Yardley spoke about earlier. Is that what you're referencing?
Yes.
I feel like it would be fair to use the proposal that he presented.
To essentially treat the rate 30 irrigation class differently, but apply kind of a single recovery rate, I believe is what the New Mexico Gas Company is recommending.
Yes.
Okay, thank you. That's all I had, Mr. Presiding Officer.
Thank you. Commissioner Fishman?
Yeah, I think, can you hear me now?
Yes.
Okay. So Ms. Deschanel, in regards to the loan and the period of recovery, let's say we pick 30 months or 3 years, would you consider a loan of that type part of the long-term capital structure?
Well, I mean,
meaning that, and let me give a little more meat to that, which is that, you know, right now they're roughly $300 million of debt that they carry. It goes up to 400 million for 30 months or whatever it is, but then it's gone. So, you know, in that context, do you consider it part of the long-term capital structure?
I don't consider it part of their long-term capital structure. And just to elaborate on that, the interest rate, every case that we've heard so far talks about the PGAC being a pass-through of gas costs. And those gas costs that New Mexico Gas Company is requesting to pass through are associated with that loan instrument that they acquired to finance the gas costs. And I'm just looking at it from that perspective. And additionally, based on a collection using that interest rate, I have that loan balance close to, and if my math is correct, I want to make sure I'm not missing, 56,856,000 roughly, based on their financing period. So by September 2022, using the interest rate of the debt instrument, that is what the balance would be. So we're looking at 56 million to be refinanced when they go back to adjust their debt.
Okay. And I guess my take is, and tell me if this makes any sense, is that if they taken on 100 million in debt and they carried that debt for a long time in the future, that would be a good argument for it being part of the long-term capital structure and cost of debt. But since this literally disappears in 2 to 3 years, to me, that's a much harder argument to make. Is that a logical way of looking at it?
Mr. Chair, I would agree with that statement.
And then I'm going to ask you to do a little bit of arithmetic. And I'd asked the question earlier about what would be the difference in cost of debt between, if we took the 0.75 of the current and assumed, which is a big assumption, but assumed it was flat over the 3 years, and compared that to their 3.7% cost of capital. That's approximately a 3% difference, rounding. Let's assume 36 months, term, as you recommend. Over 36 months, what would be the approximate difference in interest cost?
Okay, based on their 3.7 requested and the debt instrument of 0.75?
Yeah.
Okay, so if you went with 0.75 and my recommendation was for the 30-month, and I actually did do that math, the difference in interest would be approximately $4.9 million.
Oh, okay, great. Thank you. You came prepared. Okay, that's all I needed. Thank you.
Okay, any other questions from commissioners? Commissioner Hall?
So I just wanted to ask, that's a comparison of interest rates of 0.75, and what was the other rate?
3.7%.
Sorry?
3.7%.
Okay. Thank you. That's all I have.
Okay, Commissioner Vicente Aguilar?
Yes, thank you, Mr. Hearing Examiner. I think this particular hearing really gives us a point of view how to protect customers, especially when we start listening to Mr. Yardley. I always come to the commission with the thought that we have a diversity population in New Mexico. And according to the witness, Mr. Yardley, they have been listening to the other previous hearings pertaining to the extreme winter weather event. And we also have our staff members calculating rates that will impact any particular class. Today, I am learning that I am speaking for every ratepayer, whether it's New Mexico Gas Company or Via Natural Gas, Raton Natural Gas. I am encouraged that experts, rate analysis experts, are listening to the commissioner's concern from the previous cases. And I cannot appreciate that well enough. It just blows my mind that our job here at the commission is just to think about every customer. I am proud to be part of the commission today to make a decision regarding New Mexico Gas Company. We have other lawyers from different companies. We have experts listening to the commissioners, and I appreciate that very much. So I just want that to be part of the record. Thank you, Mr. Hearing Examiner.
Thank you. Commissioner Byrd, did you have any questions?
No, I do not.
Okay, thank you. Mike Smith.
No.
Okay, and I have nothing. Mr. Borman, do you have any redirect?
I do not.
Okay, and I assume that concludes staff's presentation today?
Yes, we do not have any additional witnesses.
Okay, so that concludes the testimony for today. As I said before, I'm not issuing a recommended decision. The commission is going to take this matter up, I assume, later today. Mike Smith, do you want to say anything before we conclude? Maybe give an idea of what's going to happen next?
The commission has the option to go into a breakout room to deliberate in closed session if it desires to. But that's something we can address when we get out of the hearing.
Okay. All right. Well, then, thank you, everyone. This hearing is concluded. Thank you, Mr. Lee.
You bet, Judge.
Thank you.
Thank you.
Thank you, Presiding Officer Shanauer.
Okay.
I can leave.
Unless the commissioner or Mr. Smith asks you to stay, but yeah, the hearing's over.
Hearing is over, yeah.
Was that a question for Mr. Lee?
Yes.
It's from Mr. Lee.
Yes, the hearing is terminated then. I mean,
Thank you.
We're done.
adjourned, excuse me, concluded.
Thank you, Mr. Lee.
Thank you.
Sounded a little bit menacing there for a second. And Isaac, could you put the agenda back up? And our next step is to, well, we're resuming our normal meeting here. We've concluded the public hearing. We're on to regular action items. And I don't see it the way this is on the screen, but our regular action item is to consider 21 triple aught 95 UT, the matter of New Mexico Gas Company's application for expedited variance approving its plan for recovery of gas costs related to the 2021 winter event Michael, this is yours, but I'm thinking we might want to take a break for, say, 30 minutes. And my suggestion would be to, as we have in the prior cases, talk this through and make our decision in open session. Any objection to that?
No, Mr. Chair.
Okay, so then let's come back at 2 o'clock. And I'm thinking we can go pretty quick because we got great questions that really clarified the issues.
Mr. Chairman, how about 1:45? How about 1:45?
1:45 is fine.
And wait a second, I'm gonna quit. That's when we're gonna begin to do our
Correct.
deliberation in closed session?
No, in open session.
Okay.
Okay, so we'll be back at 1:45.
Thank you.
Hi, Commissioner.
Okay, can folks hear me? Okay, Cynthia, you're nodding your head. I guess you can hear me, right?
Yes, I can. Sorry.
Okay, okay. Um, So I think what we should do here is, Michael, maybe you present. Michael, you're here?
I am here.
Why don't you present what we've got in terms of an order in front of us, and then we can go from the discussion from there.
I actually had not presented an order in the packet because the application from gas company is requesting a decision by the 16th, which is the following open meeting. And what I had proposed in my memo was that we address this in a less rushed fashion in terms of preparing a order.
Okay.
But I have an order here that I thought you
That-
prepared.
That is actually the proposed final order prepared by gas company, which needs to be modified to reflect the commission's decision.
Which decision are you talking about?
Whatever
Oh.
whatever the commission decides today
Oh, I see what you're saying.
or next week.
Right. Well,
So it sounds like what we need to do then, Michael, is resolve a few issues for you to then write into the order.
Exactly. That was my, I don't type as fast as Judy does.
We got to rename her Lightning.
fair enough.
Yes.
Yeah.
Okay, so why don't we have discussion to resolve a few of the outstanding issues, and then we'll have an order at next week's meeting. Is everyone on board with that?
It's fine with me.
Yes.
I'm taking silence. Okay. There's a yes. Okay.
Yes, yes, yes.
Okay, great. So why don't we take on first, get commissioner comments on the issue of the financing, and it seems like we were down to two options, doing the cost of capital as the cost of financing for this, or doing the actual interest rate on the loan that was just taken out for 100 million. And so I'll just open it up for discussion on how commissioners view that issue.
Well, Mr. Chairman, maybe there's a third option, and that is to secure a totally separate debt instrument that fixes the finance costs over the recovery period, which is very similar to what the previous applicants had done for this similar situation. So I have problems, combining this debt with long-term capital and attaching kind of a cost of capital carrying charge. I would rather, consistent with the principles of PGAC, have separate financing that protects the ratepayer from any kind of escalating finance costs. So maybe I'm being too simplistic, but it just seems that would be consistent to me with previous financing mechanisms used by previous applicants.
What was that acronym you used for the financing principles? I didn't hear it all.
That PGAC is a separate.
Oh, yes.
PGAC is a separate pass-through, and
yes.
And I think that the financing that we've approved has been consistent with the principle of PGAC.
Yes.
Other commissioners, other comments on that issue?
And I guess, Mr. Chair, my follow-up would be if we pursue in the order having New Mexico Gas Company refinance the debt to fix the finance costs over the recovery period, that this would prevent them from combining the 100 million or 107 million with their long-term debt. I would assume that would be a base requirement to
I'm
that.
not quite sure. Explain what you mean by that, because there's accounting entries that they make, and I'm not sure that there's any risk of them commingling funds or creating a problem there. So can you clarify?
Yeah, really the clarification stems from asking New Mexico Gas Company to maybe engage in some competitive procurement of financing by seeking out at least one lending institution that they don't normally do business with, just to assure us that there isn't better financing terms outside of the group of lenders that they normally work with.
Comments from other commissioners on this issue?
I'm not opposed to that concept. I don't know how, I don't know how it would play out, but maybe it would be a useful approach.
Okay, so I'll chip in here. It seems to me that number one, we should not be using the long-term cost of capital, weighted average cost of capital. I have a fear that if we did that, people would look at the extra $3.9 million on this simple calculation that it costs and accuse us, and frankly New Mexico Gas, of profiteering off of this event on just the financing. And that's one way to look at it, and I certainly don't feel comfortable with that. So I would go with the actual cost of whatever the debt instrument is that covers this. I also think that the testimony is very clear that when they got the financing, the bank knew exactly what they were financing, and it was this emergency. So it wasn't like the loan was taken out to finance the business as a whole. It was taken out to handle this particular problem. So I think the evidence, from my standpoint, is very strong to go with the actual loan that's taken out. Commissioner Maestas, I think you're right to be concerned about the fact that this instrument, the interest rate could vary. On the other hand, I think when they test the market, we could find that a fixed instrument is a lot more expensive. And so I'd be reluctant to dictate that they move to a fixed instrument, but would be more open to the idea that if they find a fixed instrument that they think is preferable, just ask them to bring it to the commission and ask them to look for it. We can ask them to look for it and bring the results to the commission. But I don't think we want to lock ourselves into going to a fixed instrument if it, say, costs 2.5% versus the 0.75% that we're paying now. So, I think we have to kind of hit that middle ground of go out and look, but maybe start with this extraordinarily inexpensive financing that we've got now. So that's kind of my take on it.
I have a question. Is that the LIBOR rate? Where did that 0.7 come from?
So the LIBOR rate right now is 0.1%. And the loan agreement, it's a variable loan, and it's 0.65% plus the LIBOR rate. So if the LIBOR rate goes up to 0.3%, then the total loan cost would go up to and that could shift month to month. I mean, LIBOR is it's a daily international exchange rate.
Okay.
Or interest rate.
Yes, it's variable. Okay, so I guess I would like to ride out that low level of interest as long as we can, but if we see it start to go up, or if someone starts to see it go up, the utility, I guess, come in with something comparable that's fixed would be fine, but this is an opportunity. Look, I just don't know that much about LIBOR and how much it varies. And, this is, I know it's a London bank, it's an international standard of some sort, and if that's the word.
Yes.
And there are a lot of markets that may impact it. So I don't know how likely it is to stay this low. Is this an inordinately low number? And if so, why? I mean, I don't.
Yes, it is, but it's been there for a while.
But the 3.7% is carrying charge is in lieu of the LIBOR rate. It's not in addition to.
Correct.
But still, it's 3 percentage points.
Right. So what's the other debt instrument options that we have in lieu of the 3.7% carrying charges? I think that's the issue.
Yeah, we're asking them to look, and I think that's fair, but I wouldn't mandate that we change until we see what they found.
Yeah.
Okay, I like that we could give them a certain amount of time, maybe 3 months, and see what refi opportunities are out there that could be better than 3.7% carrying charges.
Well, I think what we want to do is, let's say 3 months from now, I'll throw an example. Let's say 3 months from now, LIBOR is up to 0.3%, so that the total loan cost is now 0.9% total, or 0.95%. We may want to stay with that.
Yeah, I would say, so what? That's still a lot lower than 3.7.
And
if it gets up to be 2.5 or 2.9 or something, then maybe you should start shopping.
So all I'm saying is go ahead and shop. Show us what you've got, and then let's decide if we want to change. But when you got such a cheap rate, don't decide to drop it. That's that is a really low financing rate, and it's the advantage of customers.
Well, what about, we do know that there's an 18-month milestone, right? So what happens at 18 months, and what conditions should we place on that?
So at 18 months, for sure, they have to come up and show us the alternatives, I think. Absolutely. And I think also that if the London interbank rate starts to go up dramatically, we should require that they come to us with alternatives in that case as well.
Right. Well, and the LIBOR has to be renegotiated. I mean, yeah, it's a benchmark. They have to renegotiate or replace that rate prior to the expiration of the 18-month term. So okay. That sounds like a plan, but when we say, if we see LIBOR starting to go up, let's make some guardrails around that. Or if we see it reach a certain percentage prior to the 18-month, we might want to trigger negotiations sooner than 18 months.
Yeah. Maybe there's a trigger point, or I can see Commissioner Mastis is digesting this, trying to figure out how we spew this out into words, into an order. But I just think we need that kind of flexibility to take advantage of this really low rate while it's there, while at the same time, if it starts to go up, or if they can get better fixed financing, that they're looking for that. And that's my sense of what our order needs to reflect.
So I have a question. Does LIBOR tend to fluctuate rapidly? I don't know. Day by day? I would guess day by day, right?
Yeah,
but I mean, could it jump from?
It's daily. It's daily.
Okay.
And it's a lot like the federal, are you familiar with the federal funds rate?
No.
Okay, well, if that.
Oh, you mean the Fed rate? Yeah, the Fed interest rate? Yeah.
Is that, well.
Like on T-bills or something? What do you mean?
Yeah, that's a little different, but there's a treasury window. But it's a kind of the US equivalent, or used to be.
So maybe if we see, I mean, I'm just trying to characterize what kind of activity we would see at the LIBOR before we want to ask the utility to come in, or instruct them in advance to come in if these circumstances obtain, which would maybe be, I don't know, 3 days of acceleration of the LIBOR rate reaching, 3.5% or something. What's the other? We want to stay under 3.7%, right?
Well, 3.7 is kind of an arbitrary number. That's just their long-term cost of capital, cost of debt.
So you see what I'm getting at? I'm just trying to provide a cap or characterize the rate at which the increase is occurring or something, so we can create a trigger.
So come to us if the variable interest rate kicks up to 1%.
Say that again.
Alert us if the rate kicks up to 1% or higher from the current 6.75%, something like that. Is that what you're saying?
Yeah, only I think I'd go higher than 1% because 1% is still very low compared to 3.75 if that's a meaningful number. That's why I was saying like 2.9 or 3.5 or something like that. But yeah. I don't know what risk I'm building into such a high number.
Yeah, I'd go lower than that. I'd say more like 1.5%.
Okay.
Come see us.
Joe, do you have an opinion on this?
I don't. I'm still trying to understand like what effect, if any, the LIBOR rate has on the carrying charges. But like I think what Chair Fishman just answered that it's kind of a cost of capital based on their long-term debt, and I think I'm just looking at this in an oversimplistic way. I wanted kind of a distinctly separate debt instrument and that fixes the financing costs over the recovery period. That's I'm still in that mentality, and I'm trying to understand what we're talking about.
Oh, I'm totally with you on that, by the way. I think that is correct. They should have a totally distinct debt instrument to finance this emergency. So Commissioner Maestas, I think you're right on track there.
I guess I thought that must be what existed, only it was set at the LIBOR rate, but.
Yes, that's what does exist, but it's but it's variable. It's set at the LIBOR rate, which means that as the LIBOR rate changes, It's a
It changed.
variable rate instrument where the interest rate changes a little bit every day. So LIBOR doesn't jump up to 2% in one day. It's
That doesn't happen.
yeah,
Okay,
it tends to move, slowly with the money markets.
fine. Okay. So does that satisfy you, Joe, that there is a separate instrument, but it's set?
Yeah, there is, and I'm wondering if there's any kind of connection or a condition between the LIBOR rate and the proposal to combine the debt with all of the rest of the long-term debt.
The,
Oh, I don't.
I guess in my mind, I've never considered that even a possibility, is that have a separate debt instrument to finance this emergency. The rest of their capital structure is irrelevant to what we're discussing today. And all you charge is the interest rate to customers is the actual interest rate for the loan that covers the costs of this emergency.
So that would forbid them from combining the $100 million with the rest of their long-term debt.
So in terms of the corporate finance, the money they have in the bank account is not, if I understood their testimony correctly, they won't set up a separate account just to hold this money. They'll throw it into the same bank accounts as all the rest of their money. But for accounting purposes, they will treat the repayment of this loan and the charges for the loan to customers as separate accounts from everything else. So the money would be commingled, which is fine, but they'd have separate accounting for the repayment of the loan and for the charges to the customers.
Okay, thank you. That helps.
I think that's also better for us in a regulatory way as well. And I think it's better for the customer and for purposes of transparency. So I prefer a separate accounting treatment for the prepayment of this loan.
Yeah. And we would be seeing that in the, let's say we go with the variable rate option for a while. And let's say that goes on for 6 months before a viable alternative financing option or a better one comes along. They will be keeping an exact accounting of the interest that's being charged by the bank. And they will have an exact accounting of the surcharge that they've added to the monthly rates to recover the fuel costs that they're delaying. So those two accounts will always be right in front of us. So we'll have a very clear accounting of what the actual interest costs are and how much they've collected from customers.
So are we requiring them in our order to provide us monthly statements or something like that, weekly statements? You say they'll always be in front of us. That was why I was trying to create some trigger point, because I assumed they wouldn't be. We can order it.
I don't think we need to do monthly. Quarterly might be right.
Oh, okay. Sure.
Mr. Chair, I thought Mr. Shell's testimony was that they're going to immediately look at refinancing the debt. And so if that's their immediate plans, then perhaps, we should set a time that's reasonable and consistent with their intent to refinance and ask them to report any options, but we continue with the financing for their proposal with the LIBOR rate, without any kind of triggers on the LIBOR rate, let's say for 3 months, and they come back and let us know what the refinancing options are. That would be my preference. You'd have at least a trigger, maybe a 3-month trigger, to have them come back on any results for refinancing. And then certainly if it's financing that goes through whatever recovery period that we agree to, then there's no need for an 18-month trigger, right? We deal with the 18-month expiration, I guess, of this short-term loan.
Actually, I think there's a lot of merit to that idea, because whatever trigger we pick will be very arbitrary.
Right. I felt uncomfortable with it.
Yeah, and if we just ask them to, if we could ask them to check in quarterly, and it's not a big deal. They just literally send us a 1-page note once every quarter and tell us what the status is, and then we can evaluate whether we need to come back to approve a refinance or not.
So what will the metric be? What will the trigger be? What's our standard for a better financing debt instrument than the status quo or the proposal?
I guess I would leave it to them to make the case, because there's so many terms involved. How fixed is it? What are the loan covenants? What's the difference in interest rate? What's happening in the markets in terms of, are interest rates rising or falling? So I guess my take would be, ask them to check in every 3 months and just give us a quick evaluation of what came up, what the options are, and their evaluation of whether it makes sense to switch.
Steve, I've got a question here. So we're comparing a variable LIBOR rate, which tends to not vary that much, according to you, and is very, very low right now,
It depends
against United States interest rates, and I only really know about them with respect to like how that affects, real estate loans or something, which are, several points above the LIBOR rate. Well, I would say 4 points above, 3.5, 4 points above the LIBOR rate. But to me, 3 months seems like sort of a long time to see how much that US interest rate would fluctuate. I hear you say that's probably not a long period of time to see how much for fluctuation to appear in a LIBOR rate. But can you talk about that to me a little bit?
Well, 3 months, actually a very short time in terms of looking how those interest rates would fluctuate. That's actually asking for pretty frequent reporting in my view. But that's a matter of individual judgment. Is it likely that the rate would go up more than 1% over 3 months? Pretty unlikely.
Okay, so
very remote possibility of that.
Okay. Joe, do you like that approach?
Yeah, I'm okay with that, but I think that we should identify a responsible limit to financing costs, and in what form is it relative to the current prevailing LIBOR or the carrying charges, or rate impacts by class, by usage. I mean, floating's great. It's pretty convenient. We know that it's going to be separate, but I'm thinking of, escalating cost containment. How can we protect escalating finance costs through other alternative debt instruments? And I'm still not convinced that the proposal is the best, but I'm listening.
Well, I guess another way we could do it is say, just throwing out ideas here. I'm not necessarily saying this is the way to go, but just something to consider. Is we could say, report to us every 3 months. Let us know if it makes sense to refinance what you're seeing in the market. And then we could say, put a cap of 2.5% or 3% on the amount that we will compensate for the interest. And then it's up to them to manage the debt that they get to fall under that number. That way we're not sitting around, running around as a commission chasing interest rates and doing stuff that we don't have staff or expertise to do. We're just kind of setting a bar, and then they can come to us, and if they don't react quickly enough to changes in the market, it becomes their penalty after you go past that interest rate cap.
I guess what's bothering me is that we don't have other debt financing alternatives that signify a test of the market as a way to gauge what is being proposed. That is what's bothering me, and I'm not letting the LIBOR rate, kind of intoxicate me. I just feel I want options.
I agree with you, and I think at 3 months, that's what we should be asking for. In 3 months, we should be asking for options, and they to report back to us.
Okay.
So I'm totally agreeing with that. I think you're absolutely right. All I'm saying is report on the options, but the actual decision about whether we'll use one of them, one of the options we may choose is to stay with LIBOR or their current arrangement. But our decision might be, hey, you came up with a better option, let's switch.
Mr. Chair.
Commissioner Byrd.
Great discussion, been listening. I'm pretty much in agreement with you, Chairman, on where you're thinking on this. I think what we should do is just set the term, whatever we're going to do, 30, 36 months, whatever we think that should be. Let them stick with the LIBOR. The likelihood of it going up is very low. It's been below 1 for well over a year. It was like at 0.6 a year ago. It's at 0.2 now. It fluctuates every day a little bit, but it never goes really high. And as we were talking a while ago, or as you guys were talking and I was listening, the likelihood of it going over 2, 1.5, 2 is pretty slim. So I think for the cost right now, their best bet is to stay with LIBOR for the first 18 months. At that point, they're going to have to change it. LIBOR goes away. They're doing away with it. So we don't know what the new interest rate will be or what debt service system they're going to have, what they're able to come up with. But I don't see them being able to beat this current interest rate for the next 18 months. I think we should determine 30, 36 months, whatever you guys are thinking on that, and let it ride until this particular short-term loan is expiring. They will have to go out and find a new loan, whatever interest rate it is, and have them competitively have them competitively procure that at that time and come back and for reapproval at that time for the remainder of the loan term that we've already set here today.
So I think what I'm hearing, and I'll be corrected if I'm wrong, I'm sure really rapidly, is Commissioner Byrd basically is with the flexibility in changing in 18 months. But you're not so worried about the short-term checking in over the interim in terms of alternatives. I've got Commissioner Maestas thinking we should be checking in more often and seeing the alternatives and being sure they've looked at competitive alternatives, and that we have an opportunity to change if we need to. But both agreeing that we should not be using the 3.2 7% weighted average cost of capital as what we charge customers. We should be using the actual loan charge. So my suggestion would be maybe in between, have them come back every 4 months, every 6 months to check in with us and just let us know what's happening in the financing market. And if we need to change, Commissioner Byrd, would you be okay with that?
I'm thinking of where that mark should be. What if we say if the LIBOR hits 1%, the likelihood of that happening in the next 18 months is low. But as conditions change, if it hits 1%, at that point, there's going to be significant costs to change to a different loan. And it's better to stop the bleeding, if you will, and get to a more secure loan, longer term at 1% or even 0.75% if we want to do it at 0.75. If the LIBOR hits 0.75%, 0.75, then let's get a report. Let's find out what's going on and see if there's some changes need to be made at that time. Instead of a time frame that could be arbitrary, who knows? In 3 months, maybe the interest rate's lower and we don't need to spend the time. But if in 2 months it's at 0.75%, we need to do something now, not wait a month.
So when you say 0.75%, you mean
The
On the LIBOR rate.
is
Yeah, the
0.75.
LIBOR base rate. The base rate, not the adjustment rate.
Right. Okay.
Right.
So 0.75 plus 0.65 would be
Correct.
1.3% would be the total loan cost at that point.
Yeah, at that point they check in, let us know what's going on and if there's a better avenue.
So, Mr. Chairman, are you saying that you're trying to get consensus on approving the LIBOR rate in lieu of the carrying charges? Is that what you're proposing? And then give them time to come back, and is that what you're proposing?
Well, I think everybody, I think we've thrown out the 3.7 weighted average rate. That's not even our thinking right now. Is that correct? Does any commissioner want to go with 3.7?
I don't want to use weighted average cost of capital
That's
as
the
the
weighted
measure.
average cost. So I don't want to use it. Cynthia, you don't want to use it.
Right.
Jeff, you don't want to use it.
No, it's too cheap the other way.
Yeah, it's just, and Joe, I think you don't want to use it. Am I correct?
That's correct, but the only issue I have then, okay, now I'm clear. Now, my scowl is going to soften.
I just want to get everybody up to board here.
But I mean, in 640, our basement is to consider the 5-year treasury. And if the proposal is a carrying charge that's much higher than the LIBOR rate, are we obligated to grant them the 5-year treasury if it's over the LIBOR rate? I just feel I have to throw that in if we're talking about trying to be equitable in the interim until they come back with some refinance options.
I guess I could look up the 5-year treasury here if I was computer literate, but
I thought the rule gave us some flexibility. It did benchmark that, that treasury rate, but then it said it could also be another rate the commission chooses, or some words to that effect. Mike, could you cite the language?
Mike,
Sorry.
are you there?
Yeah, I've got to look it up. The language is states that the over collected and under collected amount shall include an interest charge or credit at the rate specified by section 621313 or at such other rate as may be approved by the commission.
Yeah.
So the 5-year treasury rate is currently 0.77%.
And LIBOR is what again now?
So the current loan would be at 0.75%.
Still beats it.
LIBOR is at 0.1%, and then you add 0.65% above LIBOR is their loan premium. So it's almost identical to the 5-year treasury rate.
Well, there would be a basis points to the treasury rate for the loan though, correct? So it would be higher than that, what they actually pay. That's the base rate plus your, so the treasury would still be higher. That's the base rate at the treasury.
Okay,
Just like the base rate at LIBOR is 0.1 right now.
I see. Steve, that extra 0.6 that gets added on to LIBOR, what gives rise to that number?
So the bank gets its money on the bank exchange daily money rate. It gets it for 0.1%. And they're saying, we're going to charge you 0.65% interest above our daily cost of getting money.
The bank is saying that.
Yeah.
That's how they make some money out of the deal. Right.
So that's their,
okay. That's
their gravy.
Their cost.
Their gravy, their profit margin.
Okay.
Okay, I was just curious. I just wanted to mention the 5-year treasury rate, but in a previous case, we were told by general counsel that in searching for, financing for these costs, that the treasury rate is not really relevant because we're dealing with extenuating circumstances. So, but since we're looking at LIBOR, it made me think about the 5-year treasury rate, but it seems that they're very close. They're very similar.
So why don't we do what Jeff suggested and Steve rephrased, but I think it's the same thing, which is to try to take advantage of the low rate associated with the LIBOR-based rate, but have the company alert us to when that rate seems to be increasing to a point that, it would dictate the company ought to be looking for getting some bids in, competitive bids in for something different. Yeah. And Jeff used, I think, a more functional measure than a time period, which to me is more rational. He was saying, watch the rate to see if LIBOR goes up, to 0.7 or whatever. And you said add 0.6 to that. So that's 1.3 in terms of what comes out of the pocket of ratepayers. So, use a functional measure like that. So it's not arbitrary.
So Jeff, or Commissioner Byrd, excuse me, I'm going to ask you to pick an arbitrary number that we're going to call not arbitrary if we went that route.
It's based on his financial judgment. I don't think that's completely arbitrary.
So there you are,
well,
Jeff.
So
based on
what I've seen is that it hadn't been over, I think it was 0.63 a year ago. So saying 0.75 most likely will ride out the 18 months unless we see some anomaly in the market that's driving interest rates extremely high. I don't see anything from our point of view from the US's perspective. When you have $30 trillion in debt, you work to keep your interest rates very low. So I don't see them ever going above 0.75. So I think we're safe at 0.75. But like I said, there's other factors besides us. So that's the number I thought was fair at 1.3% interest. It's still a low interest rate, but it's something going on that we need to start, draw our attention back to the issue and make sure we don't miss something important, causing ratepayers to have rate shock that we didn't intend.
Mhm. Sounds good to me. 0.75.
I'm very comfortable with that. And of course, we should be encouraging them, if they come up with a better loan, at any time they can come in and ask us to change it.
So we're talking about the LIBOR figure being 0.75 as
Correct.
opposed to the 0.1 something it is now, right?
Yeah, the base LIBOR rate, not the plus
Yes,
6.5.
the base LIBOR rate. That's what I wanted to clarify. Okay.
So I think that's reasonable if you guys do. Commissioner Vicente Aguilar, we haven't heard from you for a bit. Is this making sense to you?
Yes, I think Commissioner Byrd has a good proposal. And yeah, I wouldn't press stringent rules for New Mexico Gas Company.
And like I say, that's such a low cost of financing for this. I think it's terrific that they were able to get this.
Well, this is just a great illustration of economy of scale.
Yeah.
They're getting $100 million, and I'm rolling my eyes on $100 million. But our previous two gas companies, was a factor of 10 less almost.
Exactly.
And so it's just economy of scale. The banks are still making more money off this $100 million loan at this interest rate than they could ever dream of off of $10 million loan. But you still want to minimize your costs, and I think New Mexico Gas Company is in a good place to do that.
Okay, so let's just note this down. And I don't know if we need to take, I don't think we need to take a vote, but Mike, can you note down that what we've agreed to here? A trip rate of 0.75% LIBOR for them to come back in and readdress the financing.
I guess the question I have is, when you say readdress, are you proposing that they come in with an actual another financing proposal, or do we put a time limit on? Are we saying that's when they should go look? And then the question I guess that comes up is, if the rate drops again below what the trip was, what happens then?
Well, so let me try it this way. They come in, if that happens, they come in with a basket of financing proposals that they have shopped, as Commissioner Maesta says, that they've competitively shopped. And that if it makes sense, at that point, we're ready to switch to another financing arrangement. And once you've switched, you can't go back. It's done.
Yeah, the downside.
And within how much time of that should they be coming in?
Within a month, I guess. I don't know. What do you think, guys?
You mean once that trigger is reached?
Yeah. How quickly should they be coming in with proposals?
Well, I'd say as soon as they can. I guess it would take a month maybe to get bids, maybe 3 weeks. I don't know. You don't want to let it go too long. I don't know how long it takes to get bids. You would think the banks could decide in a, couple of days if they wanted to.
Yeah.
Yeah, at this level of loan rate, there's just a select number of banks that are willing to loan out $100 million. So You can probably call all of them in an afternoon.
Yeah,
So within a couple weeks?
couple days,
Let's give them 30 days.
30 days, so they can make an afternoon's worth of calls. Oh, well.
Well,
we have to
once you get the
proposals.
information, you got to weigh it out,
Oh.
figure out the total cost. It's not it's not a fast calculation, but then you got to draw up proposals.
Yeah.
Write it all down, get it to us.
Yeah.
So
Yeah.
30
It's got to
days.
go through
Fine.
Commissioner Byrd's inbox and then it's,
Then it's lost to,
yeah, I mean, come on. Yeah, we need, so 30 days I think is reasonable.
Fine.
Okay, anything else we need to cover on that? Mike, feel free to chime in if you think we're missing something.
what about the total term of the loan? What do we want to set? They asked for 30 months.
Oh, yes.
It seems to me we have to decide how long we want them to stretch it out. We've got 30 months, 36 months, and 48 months to choose from. So the term of the loan, I think, just needs to go to, whatever period we choose.
I like 36 months. It's a little longer than what they're proposing, and it does reduce the rate impact. But it's not
A little
excessive
bit.
like 48. So I thought I prefer 36.
I'm good with that.
Now they could come back and say, we've looked at all the loans. It's that we can get LIBOR's at its trigger rate, but even now, LIBOR still looks like a cheaper alternative than all the others, or a
Yep.
better alternative, a safer alternative. That might make the idea of specifying a term moot.
Well, we can't just
Other than
specify a
saying-
term.
Other than saying the loan can be no longer than the recovery date that we've set in your rates.
Right. Yeah.
Yeah, I was referring to the recovery period, and I would think that
Right.
the loan period would coincide with the recovery period.
Yeah.
Me too.
Well, commissioners, I think you have an 18-month loan in the beginning, and that is the maximum amount of time. If you pick, if you went with the 30 months or you went with the 36 months, that's the maximum time that loan could run out. So whatever term you pick is going to affect what gets refinanced and what the costs will be on once it's refinanced.
Oh, so for example, if we pick 36 months, the loan at the LIBOR rate stays steady until the end of 18 months, then what they're going to be refinancing is another 18 months, and that might be more costly than a 20-month one or something, 22-month one if they went only to 30 months rather than 36. Is that what you're getting at, Mike? Is that what you're trying to tell us, that it could be more expensive?
My understanding is that from the witness testimony was that the suggestion was obviously that the lower the interest rate is in the initial period and the more is recovered during that period, that will reduce how much has to be refinanced later.
Sure.
Correct.
And then to clarify.
And those are unknown numbers at this point.
Yes, that isn't what I was talking about. I was just talking about the cost of the second loan.
So
I didn't say that very well, but are you suggesting that to the extent we can shorten the first loan, the second loan would be less costly than it would be if we didn't shorten the first loan? Don't worry about it, guys. I might be overthinking.
Well,
Let it go.
just general finance is that the longer the loan is, the more expensive it is. So it's like if you go out and get a mortgage, a 15-year mortgage is cheaper than a 30-year mortgage.
Correct.
And that's because the lender's locked into a certain return. and there's a risk that interest rates will move on them. So they charge more to cover the risk.
Right. What I'm really getting at is the difference in rates between the first and, between the loan that exists now and the loan that we end up getting second. If we go to 18 months in the first loan, the second loan is 18 months. If we go 30 month, if we have a 36-month recovery period, but if the recovery period, for example, is 6 months shorter than that, 30 months, then it just makes a little difference in cost. But like I say, I'm not sure it's the important point.
Now, just, I thought that we designated a trip rate in the LIBOR base, and that would dictate other financing options.
Yes.
But if the trip rate, or if that threshold is not tripped within the 18 months, then we're still looking at a refinance situation.
Correct.
So
Right. Either
Okay,
30 or
okay.
36 months.
So it can't be a set of time. The only real hard timeline is 18 months for a refi and a look at options. And then before 18 months, the trip rate that we've designated is going to kick in a refi process. Is that correct? Is that?
Yeah.
Correct.
So,
Okay.
yeah. I was debating between 30 months and 36 months. I thought 36 months was a better bill impact, of course, but I do lend some credence to their concern that another weather event could hit again, and customers would be stuck with paying off the first and needing to start paying off the second. So that's just sort of an issue in my mind. I know that was part of our rationale in the Zia case to go to 36 rather than 48 months.
Okay, we're talking months, and so Cynthia, your proposal on the time period for the recovery is what?
It's not exactly a proposal. I could do either 30 or 36. I sort of lean toward 30 because of the likelihood of another event, but I don't know what the likelihood of another event is. 36 would probably work fine.
Okay, other input, what other commissioners?
I want to just further explain my 36-month recommendation in that since we're going with allocating costs by usage in February, it's hitting the residential class, as I recall, a little tougher. And I think it's the residential class that's being impacted primarily from the pandemic. And so that's why I wanted to at least consider and alleviate the compounding of the situation through this, this recovery period. That's why I liked the 36 months.
It's a dollar difference according to the bill impact, but that's of course an average. But
Commissioner Vicente Aguilar, I'm going to put you on the spot.
I agree. We should definitely give some relief to the ratepayers. 36 months is good.
Okay. Commissioner Byrd, what's yours thought?
Just for consistency, 36 months. They've all asked for shorter recovery periods, and I do understand their concerns, but I'm okay with 36 months.
so wait, I have a question. These bill impacts are calculated based on the LIBOR rate plus the premium that has to be paid with it, right?
No, actually what we're looking at, and Commissioner Maestas asked the question, is your 3.7% cost of capital rate embedded in these numbers? And the answer was yes.
Oh, okay.
So these numbers will come down a little bit, not a
So-
lot, just a little bit.
on the
because of the
true up.
lower interest rate.
Well, see, I don't think it's a big bill impact at 30 months. It's $5.60. I mean, that's not a small impact, but the next bill impact at 36 months is $4.64. So the difference is $1, a little bit less than $1. Are we really protecting the pocketbooks of the consumers that much? That's $12 a year. It's not even $12 a year. Why not let the company pay it off a little sooner and, against the risk of having to have another event come up?
We could, but I gotta say, I'm a fan of the 36 months. It is a slightly lower bill impact, and it's consistent with our other decisions.
That consistency, that's what he was talking about.
36 and
Okay,
14
Jeff.
months. So I
Yeah,
think
I'm good with that. I do agree with that. Yep. I'll go
Okay.
with 36.
So it sounds like, Mike, we're good for what you write up to go to 36%? I mean, 36 months as the recovery term? I was confusing that with the small loan bill that got killed last session. 36 months.
If Mr. Dome was actually still visible, he might have smiled at the prospect of 36%.
I was just dangling it in front of them. It was just, I was punking them.
There it is. He'll take it.
Okay, the other issue then is we've got the rate structures. So we have their original proposal, which was residential and non-residential. Then we have, or was it one across everything? I can't even remember. Then we have the second one, which was just a response to mine. What happens if you do it by class? And then we had the third proposal that they came up with after the bench request that said one rate for all, basically, except we'll make an exception for irrigation because their usage pattern was so different. And so what are the commissioners' thoughts on those?
I mean, I prefer that we choose the rate design consistent with your bench request, which is consistent with our previous decision regarding Raton. I believe it was Raton and Zia. In that we're allocating costs based on usage.
I agree with that, but I like the modification to treat irrigation. Well, isn't irrigation a separate class anyhow? Was irrigation a separate class in your proposal? I forget, Commissioner Fishman.
Oh, no, I just asked them to develop rates by class and calculate by class what the adjustment should be.
So irrigation is a separate class, is it not?
Yeah, but they did that, and actually, Mr. Yates' testimony was very good on that, I thought.
Yeah, I did too.
When he did that, and he did it, the rates for some of the larger customers really just skyrocketed.
I noticed that.
So then he came up with an alternate rate, which is actually the one I prefer, the one that he came up with to address that problem. And that's the one where all the customers, except for irrigation, were treated the same. And then he came up with a seasonal use adjustment for just the irrigation, so they didn't get slammed with a big bill for gas they never used.
Okay, so I don't understand what you're talking about when you say the same rate for everyone. But I'm looking at this last response to your bench request by Mr. Yardley. So maybe this is the wrong thing to be looking at. This has different rates. Oh, no, I'm wrong. I take it back. This is different rates based on month period, sorry. Yes, I like your proposal as I called it modified, just expressed by Yardley in his table for
Is it
36
Yardley?
months.
I can't remember now.
Yes, it's Yardley.
Okay. So I like the Yardley modified proposal
Mhm.
to protect the irrigators from getting unfairly slammed.
Mhm.
I don't see much difference, and I'm avoiding making an exception for the irrigation class since we're already considering February usage, which is not their peak. And so that's why I thought doing this according to usage minimizes the impacts to irrigators. But then to add on top of that an exception, I felt was a departure from what we've done in the past. Not that we're bound by that. And so I'm comparing the actual changes to the rate 30 irrigation class, which is table 2. Basically, let's just look at 30-month recovery impacts by rate class based on usage for the entire month of February. The increase is 4.7%, but with the seasonal adjustment in table 4, with the exception of irrigation, it's the same. It's 4.7% under the 30-month scenario under table 4. So
look at
well,
the difference. Look at the difference between the big use customers, though. Which his testimony was saying that those are pretty sensitive, rate sensitive, those customers. So that was his reasoning.
Are you guys looking at the Yardley exhibit?
Yeah.
So I didn't locate those numbers you were talking about, Joe.
okay, all right. You're right, Steve. There is quite a difference there on
So
the
Between-
rate 58 large volume.
I'm lost, guys. What are you comparing? The Yardley table with a different?
Well, I was advocating for table 2, and I think you, Commissioner Hall, and Chairman Fishman are advocating for table 4. And I guess in light of that, in light of the impacts on the larger viewers, I'm leaning towards table 4, towards you and Chair Fishman, Commissioner Hall. So.
Joe, I apologize. I was looking at table 3 and not table 4 when you were talking. Could you please give me your argument again so I understand it? Because
No, I just principally I didn't want to make another exception for irrigation if we're already considering allocating costs by rate class based on February usage. I thought that was the way of mitigating the impacts on the irrigation rate class. But I think table 4 is table 4 is the variation that accepts the irrigation rate class.
Did we do this for the other 2 companies? We did not. I think we should keep it simple and be consistent with how we treated. Wait, before I just say that. So the average monthly impact for the large volume is what you were concerned about, Steve, is pretty darn big regardless. Wait a minute. Okay, 29, let's say we're looking at 36 months. On table 2, it's $25,000. On table 4, it's 18. Okay, that's somewhat different. But what happens to let me see here. Oh, I see.
I support table 4. So, Steve, I'm with you.
Okay, I'm a table
Yeah,
4.
I think so too. I think so too.
And it just seems like it's more equitable across all rate classes.
I agree.
And Jeff and Commissioner Vicente Aguilar, what are your thoughts?
Mr. Chairman, I think the rate classes is probably the best choice for me, for equitable reasons.
So
Thank you.
would that be table 3 or table 4 that you support?
Table 4.
Okay. And Commissioner Byrd?
I'm kind of doing the same mental math I think Commissioner Massis was doing. You look at interest rates, you're like, oh, it's got to be better. But then you look at totals and it's not. So yeah, table 4.
Okay, we got a consensus. Table 4, Mike, is the rate structure that we're endorsing here.
Got it.
Is there anything else, Mike, that you need from us in order to write the order? I'm assuming the order you write will be consistent with the terms we had with our prior cases.
That I was planning on modeling it on that. Because this does have an 18-month term, I would propose that I use the same language that we used in I don't recall now if it was the Zia or the Raton case, but I think it was the Zia case initially where they had a line of credit that was variable and had a limited term that we made them come in with a new financing proposal at least 45 days before the expiration of the term of that line of credit. And I think a similar provision would be appropriate here.
Okay, makes sense to me.
Yeah.
I'm okay with it.
Okay, anything else that we need to discuss on Triple Lot 95?
Mr. Chair, and I can work with Mike on this. I guess there's going to be periodic regulatory reviews, and I don't know if that would be the appropriate opportunity to get an update on any developments regarding the gas company's efforts to expand the company-controlled storage resources. And there was a lot of evaluations, there's inquiries, and they're very open-ended. And I couldn't get a good definitive answer on when we might hear about any developments in the gas company's efforts to expand their own controlled storage. And I had alluded to maybe just if there is a material change to their gas supply in the form of additional new storage, I guess we would learn about it. I don't know if we normally see any material amendments to gas supply plans, but in this case, and as a means for me to follow through on these efforts, these initial efforts, I want to close the loop on that issue. They pursued it in the past. It wasn't cost effective to build, I guess, a new LNG storage facility, but I want an update. I want an update on that. I want an update on the inquiries with Kinder Morgan, although it's litigious in nature. I'd like to know what those inquiries are. Was the contract, the storage agreement, and the force majeure clause implemented properly? Did Kinder Morgan treat all its other storage clients the same as the gas company? I mean, these are questions I really feel it's secondary to the financing, but I think going forward, it's important to me in terms of gas supply planning. And I don't know, and maybe Mike, is this something, if we can clarify the scope of kind of the regulatory review, is that something that would be germane to a regulatory review? I know staff had asked for it. I don't recall the frequency, but is that something that we can scope out in the order, scope out the regulatory review?
I think we can address those things in this final order. I would propose with regard to the storage issue that we could issue, and without the benefit of having it right in front of me, but I think it was 13-321 or 231 was the case after the 2011 event where there were where service was curtailed, resulted in the 97 case was filed afterwards to report on their efforts to address. And I think that's, I think Mr. Shell described some of the changes that they implemented in terms of looping and things of that nature that he testified to improve service and avoid a repeat situation. So we could have them do a similar thing and basically tell us, make a filing and inform us what the result of their review about, you know, the advisability of adding storage, you know, came out to be, and staff can review that, and interveners would have an opportunity to be heard on that as well if any chose to participate in that. And then with regard to the winter, the regulatory review rather, yeah, I think we can probably touch on some of the other things. I understand Mr. Dome's objections about getting too much into detail on the negotiations that they might be having right now, but certainly within a period of time, we'll know whether that resulted in anything. And I think,
yeah, I guess I guess my questions about, you know, the contract with Kinder Morgan is more of a look back, but yet the gas supply and storage planning is more of a look forward. So that's a bigger priority for me, Mike. But I'd certainly at least like to know what developments, if any, have been made in expanding their storage.
so yeah, I think we can work those into this order.
Any,
Good. I'd like to see that too.
great. I think it's a great idea. Any objections to Mike including that in the order? No. So go ahead. Let's include that. Any other comments before we close this up?
Mr. Chair, I guess I don't know if this is germane to the order, but it seems that the company absorbed about $10 million, and it's not including that in the financing. And so I think as a great corporate citizen, they were very modest in that they didn't really constantly remind us that they absorbed $10 million, but it wasn't lost on me, and it's much appreciated. So nothing for the order, but I just wanted to kind of state that for the record.
Yes,
Yeah.
I noticed that too, and I think so too. I think that's very admirable, especially that they didn't harp on it. It's just stated, and that was it.
There you go. And for the record, I'll state that thank you, New Mexico Gas. You're very responsive to information requests. And just in specific to my request, when you saw ways to improve it, you didn't sit on it. You looked forward and came up with something better. And that's always appreciated when you're thinking and working with us. And I feel like that's what you did in this case. So kudos to you guys for doing that. So with that, I'm afraid to ask for more comments because now I'm getting really hungry. So let's close the meeting, and we'll see everyone next week. And thanks for all the thoughtful work that everybody put in today.
Yep. See you guys. Have a good one.
Take care.
Thanks, everybody. Bye.
Later.